The tariffs could definitely create some inflationary headwinds.
The effects of the tariffs are actually going to take some time.
We will not start seeing the inflation effects until a few more months down the road.
It's still too early for us to start to see a wave of inflation.
The risk to us is that we see a more persistent impact of inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, earnings season begins. This hour, JPMorgan's Jamie Dimon kicking off earnings season on Wall Street as investors look for any signs that trade policy is fueling higher consumer prices. The president is calling for the Federal Reserve to drop interest rates to 1%. A big morning coming up.
The reason why this morning is so important is because people have been looking for concrete evidence of what the ramification for tariffs will be. Will we get it? Remains to be seen. That said, we've got the 1-2 punch. First, you get the corporate earnings from the big banks. You can make an argument, okay, corporate earnings, very important. However, are banks representative of the rest of corporate America? If you are concerned about that, you can move on to the CPI report that we get on 8:30. And do you see the inflationary impacts from tariffs really hitting consumers?
3 months ago, Jamie Dimon said this. Maybe when we do this call next quarter, we won't be guessing. 3 months later, feels like we're still guessing.
Well, we're still guessing because we do not have the deals that the administration promised. And what they've done is move the timeline out. So now everyone is talking about August 1st. Can they get all these deals done in the next 2.5 weeks? Jamie Dimon also last week said, unfortunately, I think there's complacency in the markets in reaction to tariff news. One thing we did learn since Liberation Day on April 2nd is that there was this idea of the Trump put. So the markets do think that what Trump sees reaction in the market, whether it's the bond market or the equity market, pushing back on his policy, that he will reverse course. And that is why when he comes out with some of these new sky-high numbers that mirror April 2nd, the market shrugged it off.
The support this morning is coming from one single name. Check out NVIDIA. NVIDIA in the pre-market higher by 5%. This statement from this company. Filing applications to sell the NVIDIA H20 GPU again into China, the US government has assured NVIDIA that licenses will be granted.
This is a dramatic reversal from this administration. We need to remember this chip was designed when Biden was in power, and they were trying to make sure they could have a chip that would be compliant with export controls under the Biden administration. So they came up with this H20. And then in April, because of national security concerns, the Trump administration says you can no longer send that chip to China. And now what we've seen after a meeting with the president, and Jensen Huang right now is in Beijing, a reversal. And NVIDIA is saying that they have these assurances that they can start sending that chip once again to China.
This is emblematic of 2025 and of the whipsaw that we have seen, both in expectations for tariffs, in expectations for sectors, in expectation for bifurcations and then not for bifurcations within the tech sector globally. If you look at stock investors' exposure to equities that are attached to tech companies, they have increased the most over the past 3 months since March 2009. This according to the Bank of America Fund Manager Survey, and it just shows how this flipping and this flopping is reflected in some of the positioning.
Things are getting toppy, according to that Fund Manager Survey. Check this out, the biggest surge in profit optimism since July 2020. Cash levels falling to 3.9% across the board here. That is one heck of a bullish survey from Bank of America this morning.
Conditioned by experience. How many times have corporations set the bar incredibly low and then just leaped over them and shown how well they are able to really handle this? We heard from Delta. Things are stable. If you hear that from the rest of corporate America, people are more concerned about getting in than they are about some sort of risk-off move. Even that Bank of America survey that was signaling sell in certain parts, they're not saying sell. They're just saying rotate, because ultimately it has been a fool's errand to try to time this market or bet against it.
Futures this morning doing better, up 1/3 of 1% on the S&P 500. Coming up this hour, Cameron Dawson of NewEdge Wealth ahead of this morning's inflation data. Michael Froman of the Council on Foreign Relations as Europe prepares to retaliate, and Gerard Cassidy of RBC as JPMorgan kicks off bank earnings. We begin this hour with stocks rising as investors await bank earnings and the latest read on inflation. Cameron Dawson of NewEdge Wealth writing the following. Investors are feasting on a buffet of reasons to look through tariff headlines. There are reasons to see this as rational, but also reasons to see this as complacent and risky. Cameron joins us now for more. Cameron, good morning.
Good morning.
Got to pick one, I'm afraid. What is it? Complacent or rational?
So we think that the reasons for rationality make sense in the short term, because certainly we've seen the track record of Trump over the course of the last couple of months really using tariffs as a negotiating tool and saying that that's not policy destiny. And you've seen very little impact to the data or earnings from tariffs. But we're not sure if that sticks. We do know about Trump that he likes tariffs, and the more that markets rally, the more that he's emboldened to stick with these higher tariff rates. And on the data front, we simply think it's going to take time for this to show itself in the data, whether we're thinking about inflation, growth data, and really on earnings. Earnings, we have the dynamic of a big inventory pull forward, things like FIFO accounting going back to CFA level 1. That dynamic means that we're simply not seeing it pass through to company earnings yet, and it might be more of a third quarter dynamic versus something that we're going to experience this week.
Something for everyone this morning. In about 40 minutes' time, numbers from JPMorgan. Later on this morning at 8:30, CPI data. If you had to pick one this morning, what are you more focused on, the earnings or the data?
I'm more interested in the reaction to the earnings, not necessarily the earnings themselves. I think that it is very much consensus that we're going to get beats and raises. After all, the average is 80% of companies do beat on earnings, and expectations are pretty high on a buy-side whisper number that you're going to see beats and raises. I think the bigger surprise could come on the CPI side of things. And this is where we could see a dynamic where the overall CPI stays somewhat healthy or muted, but underneath the surface, we start to see evidence of the tariffs start to come through in the goods line of things. So overall CPI dampened by things like shelter inflation coming down, but then you see that evidence of tariffs working its way through the goods side of things, and it's a question of what does the Fed do with that?
Which really points me toward what the market's done with this since the last CPI print that we got on June 11th. You can see that yields are basically the same place. People are pricing in a lot of the same in the bond market. It's been incredibly stable, and yet the stock market is up 4%. What's changed since the last CPI report?
Yeah. Other than that, positioning continues to chase higher. We think that that has been the key driver of the market rally and the reason why equities have been able to defy all odds and continue to make new highs. But as you're starting to see with that BofA fund manager survey, you're starting to see in the Deutsche Bank consolidated positioning that positioning is no longer underweight. Sentiment is no longer bearish. We're now in a bullish position. Positioning looks to be somewhat neutral. So maybe not at the point yet where it is an outright headwind, but certainly less of a tailwind than it has been.
How representative are the big banks of corporate America? How much do they actually set a tone at a time where they're increasingly dancing to their own music?
Yeah, I think that there's a certain microcosm. Of course, they touch all the industries in the U.S. And so if we were thinking that there was going to be an economic downturn, these are, after all, very cyclically oriented companies. So if the economy was truly rolling over, banks would not be at a new all-time high. So this is a cyclical endorsement to see banks trading so strong. But there's a lot of idiosyncratic things going on with banks. There's questions about regulatory relief and capital relief. You also have questions about if we see an M&A, an IPO defrosting, that could certainly boost earnings. I think the thing to watch with banks is you're trading at 1.5 times book. That is the high end of the range that banks have traded at in the post-Great Financial Crisis period. So either valuations are hitting a ceiling or we are going into some brand new paradigm where you're seeing valuations be able to trade much higher than that.
The concern is tariff uncertainty, even for banks. But at the same time, tariffs have created volatility, have created a tremendous amount of opportunity for these banks. Aren't they going to ink a ton of money this quarter?
Well, certainly, I think the expectation is that you are going to see big beats and raises, and the estimates are fairly low on the sell side. It's just for low single-digit type of growth. I think it all comes back to, on the tariff side of things, is that $100 billion of tariff revenue have been raised. That's a run rate of over $300 billion for the year. The question is, who is paying it? We don't know. We do know the evidence so far is that it's not exporters. Otherwise, you would see it in import prices. So there is somebody in this economy that is paying for that $100 billion in tariffs. We think it is effectively within corporate margins. You're not seeing as much of a pass-through yet to the end consumer, but companies have the ability to block and tackle and kind of push out some of those cost dynamics and not necessarily see it in earnings this quarter.
How hard is it to unwind the actual impact of tariffs when Trump has not finalized the final rates?
Well, it's certainly uncertain. And I think that that's one of the reasons why this market is just so willing to look through it. For lack of evidence, why price it in? And so there is this expectation that maybe you will see some headwind, but by the time you get to the point that you're actually seeing it in the numbers, we'll move on to the next issue. But that's where we think that there is a certain degree of complacency, simply because estimates are for a big acceleration in earnings in 2026 as well to low double digits.
We've had something like four softer than expected CPI reads in this country over the previous 4 months. Can we make it 5 at 8:30 Eastern time?
The range of estimates for economists goes from 0.1% month over month to 0.4% month over month. So it gives you a sense of, we don't know. How many ways can you say, we have no clue which way this is going? Okay, got it. And that's sort of where we're at right now.
Even if it's softer, we've got a bunch of people still saying we're working through pre-tariff inventory, and this is noise, not signal.
And it's being absorbed by the fact that you've got pre-written contracts with certain pricing put in there. So how do you understand when we have some sort of final read on the ramifications from tariffs that haven't been inked yet? And this is sort of the certainty people are looking for. Well, good luck, because hopefully we'll get some, but, I wouldn't hold my breath.
Chairman Powell's in a tough spot. Does he just keep waiting?
We think that that's the best move. Until the employment data shows some sign of weakness, we think that they do wait, that the uncertainty about the future path of inflation keeps them in a holding pattern. Because if you don't see inflation this month, it may be coming in July. And if you see this resilience in the labor market, and I would add to that resilience within overall assets, financial conditions are still in very easy levels. This is not an equity market or a credit market that is screaming at you to cut interest rates immediately because it needs help.
Cameron Dawson of NewEdge Wealth. Good to see you. Thank you, Cam. Appreciate it. Your guidebook for this morning, in about 35 minutes' time, we should get some numbers from JPMorgan, expecting that at about 6:45 Eastern. Later on after that, the data, 8:30 Eastern time. In between, this conversation right here, 7 a.m. Eastern time, the Treasury Secretary, Scott Bessent, live and exclusive on Bloomberg Surveillance.
It's going to be an interesting conversation, of course, given the fact we have a lot of economic data, earnings coming out. And this is the man who is in charge of these trade negotiations, and he's headed off at the end of this week to Japan. This is a country that, out of the gates, they thought they were going to be able to ink a deal. They aren't. They have an election coming up the end of July 20th, around the corner. Potentially, he's going there to potentially see if they could get this deal over the finish line.
Is it Kevin, and Scott? That's my question.
What about Chris?
Yeah, Kevin, Chris, and Scott. But, in terms of the Kevins, Chris, and Scott, because I was looking at the Bank of America Merrill Lynch survey, and they actually think that Scott, a plurality of all people, think that Scott's the front runner. He's going to say, I know what he's going to say. It's going to be, I'm focused on the job that I have at hand, et cetera, et cetera. But still, how does it complicate things that his name keeps getting bandied about when he's in charge of selecting somebody?
I think the issue the president would have with, even if he really wanted Bessent to go down the block and go to the Fed. And the other day when Trump was talking about Powell, he looked at Scott in the cabinet room and said, I like you better. Of course he likes him better. But can you imagine that hole that they would have to fill at the Treasury Department? This is the individual that's leading the talks when it comes to China. No one thinks that China's trade deal talks are going to be done by the end of the year. It'd be a massive hole to fill for this administration.
I'm sure he's loving it. Wouldn't you love it? Your name's associated with being the Fed chair. You're the Treasury Secretary.
Everyone calls you the one same person.
Oh, this is so difficult to deal with.
I can't handle it.
Awful.
Terrible. I can't believe how loved I am.
Futures positive this morning by 0.4% on the S&P. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara Arnott. Hey, Yahara.
Good morning, John. We start with the check on NVIDIA. Shares are up nearly 5% in the pre-market. The company said it would resume sales of its H20 chip in China after the Trump administration reversed earlier restrictions aimed at limiting Beijing's AI ambitions. The move could add billions to NVIDIA's revenue, restoring its ability to fulfill orders it had written off as lost due to those restrictions. Meanwhile, the European Union is drawing up retaliatory tariffs for U.S. goods in case the two sides don't reach a trade deal. The list of American products is worth $84 billion and includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to negotiating after announcing a 30% levy on EU imports that will kick in on August 1st. And China's economy grew more than expected in the second quarter, driven by front-loading and strong exports to markets outside the U.S. GDP expanded 5.2% year-on-year, and industrial output rose 6.8% in June from a year earlier. But a more pronounced slowdown is likely in the months ahead due to trade tensions and weak consumer demand at home. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the president's open to talk.
The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk. We are open to talk, including to Europe. In fact, they're coming over. They'd like to talk.
Up next on the programme, we'll catch up with Michael Froman of the Council on Foreign Relations, live from New York City this morning. Good morning. Later this morning, 8:30 Eastern Time, CPI in America. Before that, a lot of earnings, including this hour, numbers from JPMorgan. Next hour, Wells Fargo. After that, Citi. In focus this morning in the pre-market, one name. It's not a bank, it's a tech firm. It's a mega cap tech firm. It's NVIDIA. NVIDIA higher in the pre-market off the back of this statement. Filing applications to sell the NVIDIA H20 GPU once again. The US government has assured NVIDIA that licenses will be granted. A surprise earlier on this morning.
And this is a huge part of NVIDIA's business. And there was a big question about how much their revenue is going to go down as a result of not being able to sell into China. Does that reverse? All we know is the $4 trillion company just got a little richer.
Stock is up by 5% in the pre-market. Futures doing nicely off the back of that, positive by 0.4%. Under surveillance this morning, the president's open to talk.
Mr. President, you've praised European countries today as standing up for Ukraine, as being strong. Will you allow them to continue to negotiate tariffs lower than 30%?
The deals are already made. The letters are the deals. The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk. We are open to talk, including to Europe. In fact, they're coming over. They'd like to talk.
It's the latest this morning. President Donald Trump signalled he's willing to continue trade negotiations while the EU finalises a list of countermeasures targeting $84 billion in US goods. Bloomberg's Mike Shepard joins us now for more. Shep, welcome to the programme, sir. It looks like we've got the list. The retaliation from Europe is being prepared. How's the US responding?
Well, the U.S. hasn't responded yet. This kind of broke late in our time yesterday. So it'll take a little bit of time for U.S. trade officials here to kind of gather it. It's not coming entirely as a surprise. The European Union has signaled, pretty openly that it would take countermeasures if it could not reach a deal with the U.S. that would avert some of the heavier tariffs that Trump is promising. Now, when the president says that he is open to talk, European officials are increasingly concerned that it's a one-way conversation. And as you heard the president say, for him, the deals are the letters that he has posted on his Truth Social platform, warning countries and trading partners like the EU of the tariffs that they should expect if they can't somehow come to better terms with the U.S. by this August 1 deadline. Now, what does that mean? For the EU, they have been anticipating at least a baseline tariff of 10%. And that is something that EU officials, including here in Washington, have signaled that might be something that they could live with. The higher 20% tariff that Trump had indicated could be coming with a new list that was beginning to circulate last week of levies that would be imposed on countries and trading partners around the world. They could negotiate perhaps around that. But the 30% level in the president's letter over the weekend, that's an eye-watering level that would really be an impediment to trade. And we heard that from Marko Sefcovic himself. He is the European trade negotiator, and he will be discussing this further with U.S. counterparts to see if they can somehow reach some solution to this impasse that is beginning to take shape and worrying producers in the European Union as well as customers here in the U.S. about the potential for our higher costs there, John.
Shep, just quickly, just an example of how quickly things can change down in the nation's capital. This U-turn on NVIDIA, you've been tracking this story, I know. What's your reaction to what we've heard from that company overnight?
Well, it's funny. Last week, Jensen Huang was in Washington to meet with President Donald Trump. We don't know what was said behind closed doors, but it's certain that he was offering the same message to the president in private that he has been making publicly, that U.S. export controls don't work and that they are impeding NVIDIA's ability to serve as essentially the American tech stack for the world as other nations and other markets pursue artificial intelligence. This is the area that NVIDIA has carved out for itself as a leader with its groundbreaking chips, but it has not been able to sell many of those AI chips in China at all, thanks to U.S. restrictions. And Jensen Huang, the CEO, has warned that ceding the China market and walking away from it simply hands it over to Huawei Technologies, its top Chinese rival, and one that could also make inroads in other markets around the world, John.
That stock is up by 4.9% of the pre-market. Shep, appreciate your time. Mike Shepard there on two stories, the relationship with Europe and the so-called U-turn on NVIDIA and some of the chips they sell into China. Joining us now to discuss, Michael Froman, the president of the Council on Foreign Relations. Michael, welcome to the program, sir. Just want to pick up on a line that you've said recently. We sometimes forget that other countries have politics too. How do the politics of Europe influence the negotiations over the next few weeks?
Well, I think that's the right question because Europe has its back up. It's not used to being treated this way by the United States. And they've gone back to their usual approach of trying to find products that they think are particularly sensitive, both economically but also politically in the United States. So bourbon from Kentucky and Boeing from across the United States that they'll put tariffs on in order to retaliate against the U.S. The question is, President Trump has said if a country retaliates, he'll simply add the retaliatory tariffs on top of the tariffs he's interested in imposing. So the 30 could go to 40 or 50 or 60. At some point, it doesn't matter. You get above around 50% tariffs, the trade is prohibited, and you're not going to bring in anything at all from that market. And that's the risk that we face if they can't reach a real deal, not a unilateral letter, but a real deal negotiated between the two.
So Brussels is looking at U.S. sensitive political pockets potentially for their retaliation. But what about the politics within Europe? Can the European Union really cajole all their members to get on board with one framework and one deal with the United States?
It's really hard. I mean, the competence for trade policy lies with the European Commission, not with the member states. But if major countries object to what the Commission wants to do in terms of imposing retaliatory tariffs, it's very hard for the Commission to move forward. And as you said, there is a division. Some are more willing to engage in a trade war with the United States. Others are trying very hard not to escalate tensions. And those differences have to be worked out in Brussels. I think President Trump has probably made it easier for them because the 30% proposal over the weekend has really galvanized opposition. They were already angry, but as your previous guest said, they sort of got used to the idea that they might have to pay 10% tariffs, that they might have to reduce some of their tariffs. I think the question is, what are they willing to do in a real deal? Are they willing to address some of the regulatory issues that have become an irritant in the relationship around the digital economy, digital services, et cetera, around data governance? Are they willing to reduce tariffs? Probably that's the easiest issue, where they have higher tariffs than we do. We have a 2.5% tariff on cars. They have a 10% tariff on cars. There's no reason why they shouldn't reduce their tariff to our level. But the question is whether the Europeans can get their act together, as you said, and put together a proposal that's compelling for the president.
Speaking of politics, there's an election in Japan in 5 days, but the Treasury Secretary is going there at the end of the week. Do you think after this election, it will be a pathway for Tokyo and Washington to strike a deal?
You know, I think the Japanese hope that they could strike a special relationship with the United States, given the security issues at stake right now in the region, given their cooperation on so many issues regarding China, regarding Ukraine over the last several years. That did not happen. I don't know how much, depending on what happens with the election, I don't know how much a change in government, if there is a change, is going to really affect their position in these negotiations. I think they've just got to come to terms that they're going to face higher tariffs coming into the U.S. The problem, of course, is notwithstanding all the Japanese investment in the United States, including in the auto sector, they still import a lot of autos into the U.S. and auto parts, and those are now being talked about to be 25% tariffs or higher. And so that is going to be a real burden on them, and they're going to have to figure out whether they can invest more in the United States and how quickly they can invest more to avoid meeting those kinds of tariffs.
Michael, always appreciate your time. Michael Froman there, the president of the Council on Foreign Relations. Just on the Japanese election, might not influence the outcome of trade talks, certainly shaking up this bond market in Japan.
You have deficits that have been climbing, and you've got politicians promising tax cuts, and that is a toxic mix, toxic brew for all of the bond vigilantes out there.
With fixed income worldwide. Up next on the program, bank earnings just around the corner. Gerard Cassidy of RBC. Starting the week in positive territory, just about. Monday at the close, positive by a little more than 1/10% this morning. We add some weight to the rally, up another 0.4%. Nvidia in focus. We'll get to that name in just a moment. It's given the Nasdaq a lift, up 0.6% in early trading. In the bond market, 2-year, 10-year, 30-year, a little bit snoozy going into CPI later on this morning at 8:30 Eastern Time. Bond yields coming in at the long end, down by 2 basis points on 10s and on 30s. Anything but snoozy over in Japan. Check out the long end of the curve. Just want to look at 30s. 30-year yields now through 3%. They were 100 basis points lower last summer. Big changes in Japan.
And it's a big change with respect to the political appetite to incur more debt at a time when a quarter of their annual budget is set aside currently for refinancing debt that was issued at those lower rates and now have these higher rates. Meanwhile, we've got politicians promising tax cuts and they're actually gaining in popularity. Raises a question. Everyone wants the privilege to act recklessly, as used to say. In the United States, they took advantage of that, and now the rest of the world has to pay the bill because ultimately there is less appetite among debt investors to absorb that and to accept some of the recklessness.
To quote the bond strategist in the White House, things have got a little bit yippy at the long end of the curve, and not just stateside, but worldwide.
Arguably more so worldwide, and arguably more so because now suddenly there's a reckoning. What does the rest of the world do with U.S. tariffs and the requirement that they spend more on a number of provisions in order to appease the president? That's causing some of the concerns and some of the desire to really raise more money through debt sales.
The Treasury Secretary of the United States about 30 minutes away. A conversation with Scott Bessent on this program at 7 a.m. Eastern Time. 3 hours away from the cash open. Let's get you some morning movers, including Nvidia. Here's Danny Berger. Hey, Danny.
Hey, John. We start there, and it really is doing the heavy lifting for this equity market this morning. Nvidia in a blog post saying that it would resume the sale of its H20 chips to China in about face from the Trump administration. Now, we don't yet have confirmation from the Commerce Department. Even so, this would add billions in revenue back into Nvidia. Shares higher by 5% easily will be at a new record if it opens up at this current price. Now, elsewhere, MP Materials. This is a U.S.-based rare earth company. Reports suggest that Apple will be investing $500 million into MP Materials. This also seems to be a nod to the Trump administration, which wants Apple's to source more from the U.S. As part of this, they're also going to be building a rare earth facility in Texas. So MP Materials up 10.33% in the pre-market trade. Now, speaking of investments, also got an announcement of a big one coming from the AI data company CoreWeave, up to $6 billion. They will be investing in a new data center in Lancaster, Pennsylvania. Shares are up 8%. They say there is more demand, so they need to meet that supply. They should have the first 100 megawatts available for customers to use in 2026, John.
Danny, thank you. Appreciate it. Here's the latest this morning. The numbers from JPMorgan dropping early. If you want the cheat guide, I'll keep it short. B, something like that. Bloomberg Sonali Basak has more. Hey, Sonali.
So many beats, John. You're looking at JPMorgan coming in strong. Interesting to see a healthy rise in the stock pre-market off the heels of these earnings, given the stock price appreciation so far. You have a lot of promise here in credit quality. This is something when we kick off bank earnings season, a lot of investors will be focusing on how much are they really factoring in about the weakness of the consumer. And right now in the numbers alone, you don't really see it. You also see a lot of promise when it comes to those trading figures, a strong beat on the fixed income trading, and also a beat here when it comes to efficiency. Efficiency is something we'll be watching across all the banks because you are seeing compensation costs rising as activity rises back again in investment banking and trading, and also as net interest margins were expected to come under pressure. But right now we're seeing a lot of health at the start of bank earnings season.
The numbers are looking good. We're expecting a boom in trading numbers. Bramo, we got that and some from JPMorgan.
You got that with fixed income sales and trading revenue coming out in at $5.69 billion versus the estimate of $5.2 billion. That's a beat there. Guess what? It's also a beat when it comes to equities sales and trading revenue. Oh, guess what? Even net charge-offs is lower than a lot of people were expecting. I love this. Jamie Dimon saying that the U.S. economy remained resilient in the quarter. So the person who is saying people are getting overly complacent is seeing reason maybe for that optimism in terms of the economic activity underpinning some of these results.
The man at the top of the bank says significant risks persist, including from tariffs and from trade. Shanali, we've got to get a look at the outlook as well. What are expectations for the outlook on net interest income for the year ahead?
They're looking pretty good so far. Remember, when we are looking at the problem here is the fact that interest rates might decline at some point this year. Of course, there is a lot of uncertainty around that, but there are a lot of questions here in terms of how much JPMorgan will actually be able to squeeze out of that consumer in the credit card books. Remember, when you look at Federal Reserve data, they have actually declined when it comes to balances across the street. So we are looking at strong numbers here across the board, but managed net interest income for the quarter, I don't know if you noticed this, John, that's actually below expectations right now. So we'll see ultimately how it pans out through the end of the year.
Stay close, Shonali. We'll come back to you in just a moment. Shonali Basak there of Bloomberg, off the back of the numbers from JPMorgan out just moments ago. A beat across the board here, everywhere you look, for equities and sales trading revenue to fixed sales and trading as well. Just the guidance coming from JPMorgan's Jamie Dimon. Think about what he said 3 months ago. Maybe when we do this call next quarter, we won't be guessing. Fact of the matter is, we're still guessing, but maybe this story is just less relevant given the resilience of this economy so far.
And it's not just the economy. It's also, there does seem to be enough certainty among corporations for them to start doing deals again. He said that investment banking activity started slow but gained momentum. This is what we're hearing across the board. So yes, maybe there isn't full certainty, but the certainty that they have certainly is positive enough to continue with a pretty rosy outlook.
Stock is up in a pre-market by 1.3%. To extend the conversation, joining us now, Gerard Cassidy of RBC. Gerard, you've had a look at the numbers. Your first take, please.
Jonathan, I think as you pointed out, the numbers were very strong across the board. Even when you exclude the one-time item that they identified, earnings came in better than expected. And you guys have highlighted some of the key areas. One particular area that I thought was interesting was the provision for credit losses was lower in the prior quarter. Shanali pointed out net charge-offs had fallen. So credit is quite strong. And this is a good read-through to not just the other money center banks, but also the regional banks. And then, as you guys have highlighted, investment banking numbers came in better than expected, and the trading numbers, particularly FICC, better than expected.
Gerard, I'm pleased you picked up on the provision for credit losses. Just compare what the bank is doing to what the bank CEO is saying. Jamie Dimon's talked about complacency in markets. At the same time, provision for credit losses is lower than expected. Do I listen to one thing and ignore the other?
John, good point. But to Dimon's credit, he's always a individual that is looking over his shoulder, looking around corners to make sure that this company is well positioned should there be any surprises on the horizon. He never rarely gets overly optimistic on credit. So on one hand, yes, we need to listen to what he says, but the numbers speak for themselves, and credit is very healthy, not only for JPMorgan, but for the industry as well.
Gerard, what do you make of the idea that we don't really have certainty with respect to tariffs? Many policies still very much up in the wind, and yet it seems like corporate America, as reflected at least by JPMorgan and Delta, have reflected a certain level of confidence. Do you see that reflected in other banks and other rhetoric that we're hearing?
Lisa, it's a good point, because when you think about when they reported first quarter results, it obviously was in April, right at the height of the uncertainty on tariffs. There's less uncertainty today. I think everybody has resigned themselves to the fact that tariffs are going to stay in place and prices will be higher. But so far, even though I know the tariffs haven't worked their way through inflation, the inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence today that the tariffs are not going to cause what many people were thinking about in April, a recession. You might remember many economists listed the probability of a recession this year, and now they're reversing that, and that's showing up in some of these banks. And I think you're going to hear other banks talk very similarly to what JPMorgan is showing today.
How much is a steepening yield curve, which we've talked about so much with reflection of what this means for the U.S. government's credibility, what this means for inflation, et cetera, how much is that benefiting the banks beyond what a lot of people have been expecting?
It's so important that investors fully embrace a steeper yield curve. And when you think about, even if the Fed cuts 25, 50 basis points this year, brings the Fed funds rate down to just under 4%, let's call it. And if the 10-year stays anchored at 4.5, 4 3/4, that's a positive slope, obviously. It's been 20 years, Lisa, that we've seen a Fed funds rate over 3% with a positive slope to the curve. That's very positive for banks' net interest margins as they reprice deposits lower. However, asset yields will increase as they renew those securities and loans made back in 2020 and 2021 at much lower yields. So that's very positive.
Gerard, last time around, the banks got a pass on these earnings calls. They got a pass because we were seeing immense policy volatility through the month of April. When they get on these calls a little bit later, Wells Fargo, Citi, JPMorgan, the big banks again tomorrow and the day after, did they get a pass this time around?
It's going to be interesting, John, because I think we're going to be focused on the second half of the year and what it means going into 2026. We also have to remember, I think you're going to hear quite a bit of discussion about the regulatory outlook. You saw the stress test results, which were quite positive for all the big banks. And now we're expecting a much watered down Basel III endgame, which is the final capital regulation that the banks will have to adhere to when that comes out probably in the fall. So I think not so much a pass, but a real keen interest on what the second half brings, particularly with loan growth and what the outlook might be for next year.
Gerard, stick with us. That name is down in the pre-market now by just 0.1% off the back of a stunning rally through the month of April, May, June and into July. We've had a move of something like 40% off the lows of the KPW Bank Index. So a lot baked in here. Expected a boom in trading revenue off the back of the volatility in the first month of the second quarter. Now it's about the second half. When they come out, and as you pointed out just yesterday, and say things like the pipelines are full, we're ready to go, are those plans derailed or delayed?
Well, and right now, Jamie Dimon is saying that a lot of the investment banking activity is gaining momentum. Can that be stalled? Is that a reason for some of the caution? Could something happen, say, another level of tariffs that causes people to pull those deals? When you take a step back, in some ways, these big banks are a perfect microcosm of a whole host of different trends. They have to answer what companies are getting in terms of conviction from some of these tariffs. They also have to answer how much efficiency they're getting from artificial intelligence. And they, I think, are at the vanguard of the technology trade as well. And I hope that that is something people really ask questions about.
We got the beat. Here's the race.
Yeah.
Here's the outlook from JPMorgan. Full year net interest income, about $95.5 billion. They had seen 94.5. I know we say this a few times, but when Jamie Dimon of JPMorgan comes out in the weeks before earnings and talks about complacency in markets, and we sat around this table and said, what's he going to do next week? Raise guidance? What have they just done? Raise guidance?
Jamie Dimon is the quintessential risk manager, and he's also somewhat politically minded. He is trying to position himself in certain ways to send messages to certain political powers. It isn't necessarily a reflection of the business. He has this mantra where he'll come out and he'll say, you know, if there's nuclear war, JPMorgan will be fine. If there's all the catastrophes in the world, JPMorgan will withstand. And that's sort of his mindset. So it isn't necessarily indicative of what they're doing in the business.
The latest from JPMorgan this morning, it's a beat and it's a raise. The stock is positive by 1% in the pre-market. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahira Arnott. Hey, Yahira.
Good morning, John. Fed Chair Jay Powell has asked the central bank's inspector general to review the $2.5 billion renovation of its Washington headquarters. Some Republicans and Trump appointees have criticized Powell for cost overruns around the project. It's a new line of attack as the president continues to criticize Powell for not cutting interest rates further. Meanwhile, Apple is under increasing pressure to rescue its struggling AI efforts. Investors want the tech giant to break with tradition by making a big acquisition and going after top talent more aggressively. The iPhone maker shares have fallen over 16% this year, lagging peers such as Meta, which, as we know, is spending lavishly on AI. And India's Civil Aviation Authority is ordering an inspection of cockpit fuel switches on Boeing 787s and 737s after a report linked last month's Air India crash to a fuel cutoff. Operators must complete the inspections within a week. Investigators' initial Air India crash report says there's no evidence so far needing action over the Boeing aircraft or its GE Aerospace engines. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, earnings season begins.
These banks are making returns on tangible common equities in the mid-teen range, high-teen range. They're generating value. They're creating value right now. We're more cautious on where stocks are trading at.
Is that cautiousness warranted? It's a beat and raise from JPMorgan, first out the gate, kicking off earnings season on Wall Street. Her stock is up by 0.8%. Up next on the program, Wells Fargo, just around the corner. Starting this morning with a beat and raise from JPMorgan. Decent guidance coming out of Nvidia on what they can sell into China. Stocks are higher, up 1/3% on the S&P, on the Nasdaq 100, up by 0.6. Under surveillance this morning, earnings season begins.
We're more cautious on where stocks are trading at. Valuations are unattractive given this still elevated uncertainty on the macro side. The deregulation side is certainly a positive. These banks are making returns on tangible common equities in the mid-teen range, high-teen range. They're generating value. They're creating value right now.
Just moments ago, numbers from JPMorgan better than expected. That stock is higher by 0.75%. Just seconds ago, numbers from Wells Fargo, not so good. With the numbers, here's Sonali Basak. Hey, Sonali.
John, while you had JPMorgan with a beat and a raise, you have Wells Fargo with a miss and a staying in line when it comes to net interest income. So you do have, remember, JPMorgan also slightly missed on net interest income for the quarter. It's the outlook now. How much more juice can you squeeze out of the consumer? I had mentioned costs were also going to be a big focus this earnings season, I would say, for Wells Fargo. Interesting to see credit quality is also really good. This is the really good news for both JPMorgan and Wells Fargo, coming in better than expectations. However, non-interest expense. This is the expenses you have control over, coming in a little bit higher than expected. The setup here was that Wells Fargo was already trading at a richer price-to-book ratio than you had at Bank of America, for example. There's a lot of promise in the stock with the asset cap lifting. So now for Charlie Scharf, it's a show me the money story. They did miss on investment banking as well. These are business lines that they want to grow over at Wells Fargo now that that asset cap is lifted. So high bar now, not everyone can be JPMorgan. They came in at more than a 20% return on tangible common equity. No one thought that they would get that this quarter. So can the rest of the banks keep pace?
Sonali Basak with the latest. Still with us, Gerard Cassidy of RBC. Gerard, Sonali repeated a few times, just on Wells Fargo. Is it a new dawn for this bank with the lift of the asset cap?
John, I really do think it is a new dawn for them. And it's well said by you because the lifting of the asset cap is significant. This company has been stuck in asset cap prison, if you will, since 2018 when they signed a cease and desist order with the Federal Reserve. And now that the asset cap is lifted, the C&D is not lifted yet, but the asset cap will allow them to grow. In fact, management has pointed out that one of the areas that has been holding them back is in the investment banking capital markets business. So we do expect that to be the first area to benefit from having the asset cap lifted at this time.
That said, these results, the fact that they missed expectations on several different measures, does it just show that this is a winner takes all or winner takes most economy with respect to corporations, with respect to households, just the sense that the big are getting bigger?
I think it shows that, again, with the asset cap in place for almost the entire quarter, you really need to grow your balance sheet in this kind of environment. And they, of course, cannot do that. Now they will going forward. And in fact, when you take a look at, going back to the JPMorgan results, I thought I read that loan growth was up 5% year over year. And that helped them with their outlook for their net interest revenue for 2025. So I think that it's very competitive, of course, and it's really being able to grow your balance sheet to help offset any pressure that they may be experiencing in their net interest margin.
I guess to rephrase this, is JPMorgan consolidating business from a lot of other banks other than representative of a globally good environment for banking? And I say this at a time when we know they've acquired assets from some of the regional banks that had been struggling. And it does seem like there is an advantage in size as well as just footprint.
It's interesting that size certainly comes with economies of scale. But one of the things we have to point out with JPMorgan compared to Wells, for example, is JPMorgan has a much bigger consumer business driven by their credit cards. And the return on equity in their consumer business at JPMorgan was an astounding 36%. And that's what really drives the value here. Bank of America is close to JPMorgan on the consumer side, but Wells is not there yet because Wells doesn't really have the presence in the credit card business that JPMorgan has, which is a very profitable business for the credit card players.
Gerard, later this morning we'll hear from Citi, then we'll get numbers from Bank of America, from Goldman, from Morgan Stanley through the week. Based on what you've seen so far and what you can read through the tea leaves for the second quarter, what kind of bank do you think does well in this environment, and what kind of bank is going to perform in the year ahead?
I think, John, the banks that do well in this environment are the ones that are funded with cheap core consumer deposits. When you look at a Regions Financial, which is a regional bank, of course, and 30% of their deposits are interest-free. And when you have levels of deposits that high that you don't pay interest on, and the Fed funds rate is obviously over 4%, you could do quite well. The other area that we're watching is on credit. So the banks that show good results on credit, and both these companies did, that too would do well. And of course, as you already have identified, the capital markets investment banking business is important, and the big money center banks are the players there, along with, of course, Goldman and Morgan Stanley.
Gerard, the first reaction in markets isn't always correct. And today might be an example of that, because based on the tone of your conversation, it seems like you're more interested in what Wells Fargo does in the year ahead than JPMorgan, even though JPMorgan increased their expectations, their outlook, and Wells Fargo didn't. Am I getting that right?
No, you certainly are getting that right. And again, it was idiosyncratic, of course, to Wells for having the asset cap lifted. So we really have to see how they perform over the next 12 months. And ideally, I think they're going to show some good growth, which they haven't been able to do because of that asset cap. And that's not to take anything away from JPMorgan's results or the outlook for them as well. But it seems to us that, the real upside potentially could come from Wells Fargo when we're sitting here possibly a year from now.
Hey, Gerard, appreciate your time. You're going to stick with us, I'm pleased to say. We'll catch up with you a little bit later this morning. Numbers from Citi about an hour away. So far, so good. Numbers better than expected, almost across the board. Let's take JPMorgan. Expected a boom in trading. Got one. Better outlook. Got one. The surprise beat in investment banking and fees related to some of those activities, I think, is indicative of maybe the cloud starting to clear just a little bit. Perhaps some renewed confidence in this economy off the back of the resilience we've seen over the past few months. And I think a lot of people at these banks will hope that continues for the year ahead.
Jamie Dimon pointed to the one big beautiful bill in Washington, D.C. passing, and that gave some confidence to corporations of what at least the tax and investment landscape would look like going forward. And maybe that was enough for them to really pull the trigger, for them to see the increase. Again, I want to see how much they're consolidating business from other banks and how much actually in absolute this is an area that's picking up.
Also, he noted the potential deregulation for this continuous push from the Trump administration to deregulate in all parts really of the economy, but he had a warning. Quote, significant risks persist, especially from, quote, tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficit, and elevated asset prices. When it comes to tariffs, you hit the nail on the head. Is anything different from April? It isn't. We owe uncertainty, but the market is just shrugging this off because they think there's a threshold that Trump will, if potentially the markets push back, he will unwind.
They've always got a warning, right? I'll freak out when Brian Moynihan starts to look worried on TV. Because otherwise he's super direct, right? Very calm, everything's okay.
Yeah.
Jamie's running around saying clouds, storms, all of those things. When Brian starts to worry, I'm going to start to worry.
Yeah, when Brian says my hair's on fire, well, we'll all duck.
There's a reason for it. Equity futures right now in the S&P, positive by 1/3%. In the next hour, the US Treasury Secretary Scott Bessent, Sarah Hunt of Alpine Saxon Woods, Elyas Galou of Bank of America, Matt Hornbach of Morgan Stanley. Next up, Scott Bessent, just around the corner.
There's so much in this market that is really attractive.
If you're looking at kind of what's been working in markets the last couple of years, it's quality stocks.
But we do favor large caps in particular because of adaptability.
What I think has surprised everybody, ourselves included, is the sheer resilience of the US corporate sector.
You're going to see a kind of beat and raise scenario that is the next leg of the market driving higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with equities close to all-time highs. Equity futures on the S&P positive by 0.4%, on the Nasdaq up by 0.6%. Bank earnings out just moments ago from JPMorgan. It's a beat and a race.
Yeah, right now people are looking at the potential for these banks to keep making money, not only from interest being significantly higher, but also investment banking activity coming back. And this really goes to the difference between Jamie Dimon's warnings of gloom and doom and the reality of a beat and a raise, which is what we just got.
In 60 minutes' time, another read on the banking sector and Wall Street. We'll hear from Citi. Look out for that in 90 minutes' time, 8:30 Eastern time. U.S. inflation data in focus.
This is going to be in focus, especially for the administration, which has been talking about the fact that inflation has been coming down. We had 4 consecutive prints of better inflation numbers. Will we get a fifth today?
Equity futures this morning higher by 0.4%. Coming up this hour, the Treasury Secretary Scott Bessent ahead of President Trump's August 1st tariff deadline. Elyas Galou of Bank of America on an excessively bullish global fund manager survey, and Matt Hornbach of Morgan Stanley counting down to US CPI. We begin this hour in Washington. President Trump leaving the door open for trade talks and piling on the pressure for the Fed to cut interest rates.
We're still willing to talk. Literally every country wants to make a deal. We have no inflation. Our stock market hit record highs. With no inflation, we should be at 1%. Thanks as well to Treasury Secretary Scott Bessent, who's doing a fantastic job. He goes on television and he calms the market. I go on television, I rile the market.
It's time for some calm. Joining us now, the 79th Secretary of the Treasury, Scott Bessent. Mr. Secretary, welcome to the program, sir. Let's pick up on that theme. Not you calming the markets, but on inflation and where rates should be. As Annmarie pointed out, we've had a string of softer than expected inflation reads in this country. We've had 4. We might get 5 at 8:30 Eastern time. Why do you believe that's signal and not noise?
Well, I mean, there's some persistence there, Jonathan. And look, I do have access to the number of the night before, but when I'm coming on TV, I don't look at it. So I don't know what the number is going to be at 8:30. And I wouldn't, I don't know whether it's going to be down, up, or flat, but I wouldn't put too much emphasis on one number. I think it's the trend. And I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
And there are some people on the FOMC, the Federal Reserve, still worried about the prospect of that happening through the summer. We've all sensed the frustration from the White House across the administration with Fed Chair Jay Powell. And a lot of confusion, I think, at this point that maybe we can address in this conversation. Is firing the Federal Reserve Chair under active consideration in the White House and the Treasury in your administration?
President Trump said numerous times he's not going to fire Jay Powell. He's working the refs. And I've said before, I'm a basketball fan. There are 2 schools of working the refs. There's the Bobby Knight School and there's the Dean Smith School. President Trump seems to prefer the Bobby Knight School. And I'll tell you, I went back over the weekend and looked, and Bobby Knight won 3 NCAA championships. My hero, Dean Smith, only won 2.
The NEC director, Kevin Hassett, I'm not sure what you'd call him, but he was asked over the weekend, can the Fed chair be fired? He said that's a thing that's being looked into. How should we understand those comments?
Look, and I will point out, Kevin was a collegiate basketball player. And I think, as President Trump said, he's not looking to fire Chair Powell. And as I've said, I'm not going to comment on future policy or future mistakes the Fed will make. I'll only comment on past mistakes. And look, they've had some big forecasting errors, and this may be one now.
Is there a reason for not firing him? And I ask that question because the president's also said that his term is about to expire in May of next year. Is that the reason to ultimately just wait? Or is it something else? Are you convinced by the negative consequences associated with such a move?
Look, I think an independent central bank is very important for the conduct of monetary policy, and we can see that in terms of both the financial markets, the term premium, and longer-term debt.
You said previously the interview process would begin later on in the fall. There's been plenty of speculation as to whether that process would be brought forward. Mr. Secretary, do you still, as far as you understand, believe that's when the interview process to replace the Fed chair will begin in the fall, or has a formal process already started?
Well, look, there's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Do you see any merit at all in selecting maybe a candidate that's already on the committee on the FOMC versus taking a look at someone outside of the Federal Reserve?
Again, there are a lot of good candidates inside and outside the Federal Reserve, Jonathan.
Has the chairman himself, the Fed chair, Jay Powell, given you any indication whatsoever as to what he would do once his term has expired? Will he vacate his seat as the governor of the Federal Reserve?
Well, traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
Mr. Treasury Secretary, I'd love to talk to you about what's going on in NVIDIA this morning. Jensen Huang, the CEO, out in a blog statement saying that the company has, quote, provided an update to customers, noting that NVIDIA is filing applications to sell the H20 GPU again. The U.S. government has assured the company that licenses will be granted, and NVIDIA hopes to start delivery soon. Can you attest whether or not that's true or not? The United States is willing to let NVIDIA sell H20s once again in China?
Well, again, Annmarie, I think that'd be a judgment that the Chinese indigenous manufacturers, namely Huawei and some others, already have an equivalent chip. So if there's an equivalent chip, then the NVIDIA H20 could be sold, because I can tell you the one thing that we do not want is a digital Belt and Road springing up around the world, because other countries or China are substituting for our American chip manufacturers.
This is the same chip, though, that the Trump administration blocked with export controls in April. So why the change in policy now?
Annmarie, you might say that was a negotiating chip that we used in Geneva and in London.
So this was part of the trade talks when it comes to Washington and Beijing?
Yes.
Was it a quid pro quo then? As you said, it wasn't, but was it potentially to make sure that you can get the licenses when it comes to rare earths?
Yeah, I think it was all part of a mosaic. They had things we wanted, we had things they wanted, and we're in a very good place. I expect to meet my Chinese counterpart, the vice premier, in the next few weeks.
So when and where will that meeting take place?
We're still working on that. The Chinese leadership has a big conclave at the beginning of August, so we're trying to work out whether that could be in a third country before or after that conclave.
Will the administration release the framework of the Geneva and London talks?
Well, we have released some of it, and I'll tell you that now, having settled on tariffs, on the export controls, we can move on to the next stage of talks. And I think it's very important, both for the global economy, for the U.S. economy, and for the Chinese economy, for us to move on and talk about China opening its markets and the increased domestic and consumer production there.
Are you hoping to get to that next phase before August 12th, when that's currently the détente between these two economies?
Yeah, I think we're in a very good place, and I tell market participants not to worry about August 12th.
Should they worry about what's happening with Europe with respect to the 30% tariff rate? They don't seem to be worrying, but I'm just curious whether that's the final rate or whether the letter was part of a negotiation that Europe received from President Trump.
Well, Lisa, what I would say is President Trump's able to create a lot of leverage here, because he's indifferent. He's indifferent whether we take in the 30% rate or whether the Europeans come to us with a much better deal. As I've been saying for a while, that if countries or trading blocs don't come with their best deals, then the rates could boomerang back. So President Trump's leading this. And what I will tell you is that a lot of the deals, and this is where his leadership's been invaluable, a lot of the deals that I thought were excellent deals keep getting improved upon every time he takes up the maximum pressure strategy.
There is a theory in markets, and you don't even have to calm them. They're pretty calm. They're watching all of these rates, and they're not freaking out in parlance on Wall Street. They're taking this in stride. We're close to all-time highs, if not at all-time highs. Do you see this as giving a green light to Trump, to President Trump, to keep going, to take hardline approaches, and to keep trying to get better and better deals?
Look, I think this narrative of this obsessive focus on the market isn't right. President Trump views this as a generational opportunity to reset trade in a fair and sound manner for the American people. So the idea that some market ups or downs are going to be the deciding factor here is what we are concerned about, and President Trump is laser focused on, is getting the best deals, because we were not having fair trade, and now we're seeing, with these countries coming to the table, the quality of the deals gets better and better. So we're not going to rush just because of some market deadline. Now, I think what the market's seeing is markets willing to look forward 3, 6, 12 months, and this is going to be good for the U.S., it's going to be good for the global economy.
If you do get some sort of signal from the market, though, that this isn't going to be good for the U.S. economy, is there a trigger point? Is there sort of a sense at which it acts as a gut check and sort of pulls back some of the negotiating tactics?
Look, I think the market understands what we're doing. Sometimes individual market people don't. Sometimes the television personalities don't. But good thing about President Trump is he always tells you what he wants, and what he wants is fair trade here.
I won't take that as a slight on me and my colleagues around the table, Mr. Treasury Secretary, but you did tell me on April 2nd, on Liberation Day, that this was the ceiling when it comes to those rates. But since then, we have actually had some tariff rates the president announced in letters higher than those rates he announced on that big chart on April 2nd. So is there no longer a ceiling when it comes to tariff rates when you are dealing with trading partners?
I think that I said if they come and they negotiate in good faith, then those are ceilings. And some of the talks got off to very slow starts.
So who's negotiating in good faith at this moment and who's not?
Again, I congratulated the UK the other day, as I told many of our trading partners, and Annmarie, I may have said on that day or a few days after April 2nd, I'd advise countries to move quickly, because with President Trump, the first deals are usually the best deals. And the UK came in early, they got a great deal, and everybody else is kind of dragging right now.
Well, when it comes to Japan, you're headed there at the end of this week. Do you expect to come back with a deal?
I'm going to Japan to represent the United States government and the American people at the International Expo, which we used to know as the World's Fair. So this coming Saturday is going to be America's Day, and I'll be taking a delegation, includes the Labor Secretary, Deputy Secretary of State, will be representing the U.S. So this is a celebration of the U.S. more than trade talks.
Mr. Secretary, before you go, just a final question. I'm embarrassed to say that my knowledge of college basketball is nothing like yours, but I can tell you back in the 90s in English football, there used to be a concept of player managers. There used to be certain managers of football teams that also put themselves on the field and they played too. Effectively, they had two jobs. And I'm wondering from your perspective whether that's something you'd be interested in. We've seen that throughout the administration. Is that something you think that you could pursue, both the Treasury Secretary and the Fed chair?
Look, I think I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process, Jonathan.
Has he asked you?
What's that?
Has he asked you? Are you part of the process?
I am part of the decision-making process, but again, it's the final decision is going to be President Trump's.
Mr. Secretary, appreciate your time. Thank you. The Treasury Secretary there, Scott Bessent, on a range of issues, including trade and the future of this Federal Reserve.
Yeah, talking about how if Fed Chair Powell remains on the board, that it could be somewhat confusing after his regime as Fed Chair is up. I think that that's really notable. He also was talking about some of the negotiations and how the market is perceiving them and how it doesn't really matter, but sort of, it seems to be reflecting well on the whole process.
Also, Jonathan's last question, are you part of the process? It wasn't that he was part of the process as a candidate. He was part of the decision-making process, although he did say the final decision will come down to the President.
Important clarification. You can see the frustration with the Fed Chair, Jay Powell, on a range of issues. They'd like a decent understanding, I think, about his future once his term has expired. Will he be stepping down and vacating his seat as the Fed governor? And I think the Treasury Secretary was pretty clear about what the administration would expect to see in the next 12 months.
Absolutely. They are also hoping to see, when it comes to inflation coming down, an opportunity for this Fed to cut rates. Of course, the Fed will say, show me the tariff rates, then maybe we can cut rates. And then also interesting, I really think this is the clearest signal we've yet to get from someone in the administration or the Fed that Jay Powell is not staying on after he is Fed chair. He could stay on as a governor till 2028, but the Treasury Secretary is saying it's confusing if an ex-chair stays on the Fed board when a lot of people, including Democrats, are throwing criticism at this administration for this idea of a shadow Fed chair. I think that was a clear signal that Powell is going to go when his chairmanship is done.
We'll continue the conversation throughout this morning. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Big bank earnings are underway with JPMorgan and Wells Fargo both reporting in the last hour. JPMorgan shares are now lower by 0.4% after the bank saw a 7% jump in investment banking fees, and stock traders posted their best second quarter ever. Meanwhile, Wells Fargo shares are lower nearly 2% after it cut its full-year guidance for net interest income. Next up is Citi, which reports in the next hour. Meanwhile, the European Union is drawing up retaliatory tariffs for U.S. goods in case the two sides don't reach a trade deal. The list of American products is worth $84 billion and includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to negotiating after announcing a 30% levy on EU imports that will kick in on August 1st. And staying on trade, the Port of LA saw its busiest June ever after a slump in May, with the whipsawing trade war pushing shippers to beat shifting deadlines. But trade forecasters expect a severe drop for the rest of the summer and through the holidays, which start in November, which is typically peak season at the ports. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, inflation is dead.
The economy is roaring, business confidence is soaring, incomes are up, prices are down, and inflation is dead. It's dead. Without us, you have no world. And we put our country on solid footing.
In just a moment, Sarah Hunt of Alpine, Saxon Woods. Equities are positive by 0.4% on the S&P, up as well on the Nasdaq. Under surveillance this morning, inflation is dead.
The economy is roaring, business confidence is soaring, incomes are up, prices are down, and inflation is dead. It's dead. We're doing great. We have no inflation. Think of it. Our stock market hit record highs. Everything's hitting a record high. We're really running good with no inflation. Without us, you have no world. And we put our country on solid footing.
Inflation data due at 8:30 Eastern Time. About an hour away. Joining us now is Sarah Hunt of Alpine, Saxon Woods. Sarah, good morning.
Good morning.
Is inflation dead?
I think it's quiet at the moment, but I wouldn't completely rule it out. I think that there's some possibilities that it could pick its head up, but I think that it's hard for people to anticipate data when we spend a whole lot of time anticipating a bunch of stuff that didn't happen. So I think there's a little bit of fatigue there, so it's hard to say right now.
It's difficult to forecast. There's still some debate over the data we've already had. What's underpinning these softer than expected reads, and why won't it last?
So if we think about whether or not companies did a huge pull of inventory forward and or people started changing their behavior because they knew what was coming, you could argue why that's soft now and why it should rise if the rates are going higher. But you still see these moving of the goalposts in terms of timing, which allows companies to bring inventories back in again and refresh that. So I could see a lot of bumpiness in the data, and I also think that companies have had a lot of time to prepare for this. And if I'm sitting there, I want my margins to stay where they are, so I'm going to try to do whatever substituting I can. So I also think that there's probably a lack of understanding how much of that substitution has gone on, and I think that that is why it could be bumpier and less dramatically higher than people are expecting, because they're expecting a really fast move.
I just wonder, can we expect immaculate disinflation, ongoing immaculate disinflation where there is no pain in the overall economy at the same time that inflation is dead? Does that seem consistent with you, or is there kind of a tension right now between employment data that's pretty okay, albeit with very slow activity, and inflation that seems to be, maybe if not dead, in hospice?
It is one of those periods of time where figuring out what that data means is going to be tricky. It remains tricky. Earnings are going to matter for the stock market. Inflation is going to matter to some degree, but only if it's really surprising or gets much higher than people are looking for. And then investors really start to worry. The question is, what do those trends look like? I mean, to Treasury Secretary Bessent's point, it's not just about one number. It's about where the trend is going. If it looks like the trend is reversing, investors are going to like that a whole lot less.
Do you just not pay attention to the data at all and buy AI? Buy NVIDIA and just, call it a day?
It would have been the good trade for this year, right? I mean, that's sort of what happened, is that you had all this concern about AI going into the beginning of the year. Then you had the trade situation. Everybody started looking at every single earnings call from Microsoft or every hyperscaler to parse exactly what their spending was going to be. There was this little bit of freak out, and then everybody got over it really quickly. So that would have been that reversal. And that goes back to the idea that the companies that have growth and the companies that generate a ton of cash and have good margins are the places that they end up performing better than the rest of the market anyway.
It would have been good to get in on NVIDIA just last night, given the fact that they have a blog post out saying that those H20 chips that this administration blocked are now going to be able to go to China. How do you deal with this basically flip-flop almost within weeks or months of this administration when you're trying to direct what to do in a portfolio?
Well, I mean, flip-flop is an interesting term. I think it's more about, again, to Treasury Bessent's point, it's changing those dynamics may have been part of that discussion all along. So you have to assume that some of the things that are coming out as X or Y, maybe X or Y under certain circumstances, but if I change my mind, they're going to be different. So that's got to be, and I don't think that that's entirely different from things that the way the world works anyway. But I think that certainly in the near term, this administration has been much different about market changes than other administrations.
It's not just NVIDIA, it's AMD just resuming shipments to China once their license clears. That stock is up in the pre-market as well.
Look, China's a big business for all of these chip providers. And the key question is, can they understand the rules of the game enough to create chips that are compliant with some of the constraints that have been put on them from the U.S. government?
Sarah, it's good to see you. Sarah Hunt of Alpine Saxon Woods. AMD is up by 5%, NVIDIA up by 4.4%. It's been a big morning already. Decent numbers from JPMorgan, a beat and a raise. We heard from the Treasury Secretary just moments ago on this programme, endorsing central bank independence. The formal process to replace Chairman Powell is already underway. It started. More on that in just a moment. Plus this, Elyas Galou of Bank of America on an excessively bullish global fund manager survey. Plus, Danny Berger with your morning movers with another look at the nation's biggest banks. From New York, this is Bloomberg. This from the Bank of America Fund Manager survey so far this morning. Sentiment getting toppy. They say investor sentiment is the most bullish since February 2025. The biggest surge in profit optimism going back to July 2020, and a record surge in risk appetite over the past 3 months. Sentiment's getting toppy.
Yeah, although interesting when they say that this typically has been the indicator, they've sold, and it would have been a good thing to sell. Right now, they're not saying to sell, because ultimately, how do you fade something that seems to be underpinned by a whole host of different themes? That's just difficult to really just outright pull against.
We'll talk to Bank of America directly about that survey in just a few minutes' time. Futures up on the S&P, up by 0.4%, on the S&P 500, up by 0.6% on the Nasdaq. Some big stories out there for the banks and for big tech as well. With 2 hours until the opening bell, with your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Yeah, a lot to work through this morning. The first of which, about more than an hour ago, we got earnings from the big banks. Interesting to see JPMorgan give up its gains. At first, when it announced we were off to the races, a beat and a raise. Investment banking did better than expected. Traders, a record first half. You see some ebbing of that sentiment. It's now down 0.4%. Wells Fargo really taking a hit, though. It missed on its net interest income, even though it did see a beat on EPS. We also had some of the smaller banks reporting. Bank of New York Mellon, for example, they reported those shares are still up, but they are off of the highs of the morning, only up 0.5%. Really seeing sentiment again across these banking names start to ebb. For them, it was also a beat and a raise, really reinvesting a lot of their maturing securities at higher yields, helping them to up their revenue. Finally, moments ago, this breaking, John, you had mentioned it before the commercial break, AMD saying that it was preparing now to export its MI308 chips to China. This is a chip that had been blocked, but it says that the U.S. Commerce Department is now re-reviewing those licenses. When it initially got blocked, it said it was an $800 million hit it would take to its earnings. So with the resumption of that, shares are up 5.6%, John.
This is a big change in Washington, a big change we're following this morning. We'll keep tracking. Danny, thank you. On our radar this morning, Treasury Secretary Scott Bessent telling us not to put too much emphasis on this morning's CPI data, saying it's more important to look at the trend. Bessent adding the process to find a replacement for Fed Chair Jay Powell has already started.
What's interesting what's going on with the Fed, and he's talking about this process. The process is already started. He's saying he is part of the process in the sense that he is giving that guidance to the president about a decision, almost sort of put some distance between himself and potentially going over and running the Fed. Then he said this: traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of shadow Fed chair causing confusion in advance of his or her nomination. I can tell you, I think it'd be very confusing for the market if a former Fed chair to stay on. This is the big question for this administration. After Powell's chairmanship is on, will he stay on as governor in 2028? I think it's a clear signal that it's not likely.
There's a larger issue here, which is how does this administration want to reshape the way that the Fed really does approach monetary policy? Is there some sort of larger overhaul that Kevin Warsh was really alluding to when he was talking about regime change and how they calculate certain aspects of the economy? And that, I think, increasingly is going to be the question as we parse through who the replacements to some of those empty seats will ultimately be.
We witnessed all the pressure on Chairman Powell over the weekend, and we woke up Monday morning and hardly saw any movement in the price action whatsoever. I think the fact that we have Scott Bessent in the Treasury seat right now brings this market a lot of comfort to come out and talk about central bank independence the way he did, draw a line under it and hopefully move on, I think is some of the reason why you haven't seen markets move in quite the way they would if Secretary Bessent was saying the kind of things that Kevin Hassett was over the weekend.
People view him as sort of the arbiter of calm, and President Trump obviously looks at him to that, given the fact that he says, I come out in royal markets, and he comes out and he calms them. At the same time, Scott Bessent seems to be coming out and saying the market is taking everything in stride because they see the long game. And overall, the long game is not to disrupt the independence of the Fed, and it's not necessarily to create a trade war just for the sake of it, but it's ultimately to get income and to create a more fair landscape. You know, whether that's actually what the market decides after we see the rates, et cetera, we shall see. But I think it gives you a sense of what the framework is that he sees.
He understands the bond market.
Yes.
If you want lower rates, don't fire the central bank governor. If you want higher rates, fire the central bank governor. Or the Fed chair in this case.
I'm guessing he wouldn't come out and say drop rates to 1%, and he thinks that that's appropriate for the Fed funds rate, because probably if Scott Bessent were to say that, you would see a real reaction in the long end.
We'll have more on that conversation in just a moment. I want to turn to the bank results we've had so far. Kicking off on Wall Street early this morning, JPMorgan reporting equity and FIG trading revenue that beat estimates. On the flip side, Wells Fargo missing net interest income estimates and cutting its full-year guidance. Two very different stories this morning.
Yeah, although one consistency, and that is that their loan loss provisions came in lighter than expected, both of them. So if you're worried about credit quality, well, it looks like that's not as much of a concern. You know, you see both of the shares down, and they're down for different reasons. JPMorgan shares have been up some 40% this year. I mean, this has been the high flyer, and so some people are saying the bar is just too high at this point for them to cross. Wells Fargo is more interesting, especially given what we heard earlier this morning. How much do they have more optimism ahead of them because of the asset cap jail that they had been in that had been lifted. Is that something that they can see? I mean, how does the market judge that if they're not giving any good guidance to that extent?
Citigroup's up next. We'll hear from another one in about 25 minutes' time. I said two big sector stories, one in the banks, Lisa going over the financials. We need to talk about tech. Chip makers rising in the pre-market. NVIDIA planning to resume selling its H20 AI chip in China. AMD, just moments ago, also preparing to resume shipments of its MI308 chip once its export license is cleared. It's a U-turn from the administration.
It is a U-turn. This chip was developed under the Biden administration, so it could be export compliant to send to China. Trump administration comes in and they say you cannot sell the H20 to China. And guess what? We have had Kevin Hassett, we've had the Treasury Secretary in the past say this is not quid pro quo. We're not going to make sure that we do anything that goes against our national security. But what did he say to us this morning? NVIDIA chip decision is part of a, quote, mosaic of the China talks, basically saying this was part of an agreement. And he used the term a chip we were going to use when it comes to the deal making, the détente they had with Beijing.
Yeah, he also said something else that I thought was really provocative and interesting, which is he doesn't want, or they don't want China creating a digital Belt and Road. And this idea, the nod to you want to win the global war for AI infrastructure. And you can't do that if you really separate chips from the U.S. going into basic Chinese goods, not necessarily military, but basic Chinese goods.
Two big movers in the pre-market, lifting this equity market higher by 0.4%. Let's talk about this stock market and turn to investor sentiment. The Bank of America Fund Manager Survey out just moments ago. The title, Sticky Toppy Pudding. Joining us now, Elyas Galou of Bank of America. Elyas, welcome to the program, sir. Just across the board, optimism, optimism, optimism. You and the team have called it toppy. Is this a sell signal?
Look, I mean, yes, one of our famous trading rules that we highlighted in the fund manager survey did trigger a sell signal. I'm talking about the FMS cash rule, which really look at how investors are invested in the market. And this month, the cash rule fell below 4%, which did trigger a sell signal. And there have been roughly 17 sell signals since 2011, with an average return for the S&P 500 of minus 2% over the following 4 weeks. But really, I think, John, what stands out from this month fund manager survey is hedging, rather than just saying that where the market is getting toppy. Investors are very much more inclined to hedge their positions, what did really well in their portfolio in 2025, and rotate towards assets that have underperformed in the first semester, rather than just sell outright their position and retreat for the rest of the year. And in fact, if you look at market price action since the beginning of the second semester, it's corroborating the bottom line from the fund manager survey. Assets that had underperformed in the first semester, like cryptos, like home builder stocks, biotechs, and even renewables, are now doing quite well in the second semesters. So we think hedging is really the word to remember this month.
Does that mean hedging some of the big tech exposure, given the rapid increase to allocation in that space?
Yeah, I think it's really important to highlight the rapid increase in tech allocation. I mean, over the past 3 months, since really the low of April post-Liberation Day, FMS exposure to global tech equities has risen by the most since March 2009. You see here the extent of the recovery in sentiment and positioning. There is, yes, the recovery in positioning to tech, but there's also the recovery in terms of profit expectations. We saw over the past 3 months the biggest a rise in optimism when it comes to EPS growth expectation since July 2020, when the world was still battling with COVID. And you highlight here the big conviction from FMS investors. They are very bullish on AI, they are very bullish on tech stocks, and they think that it is going to be tech and large cap AI stocks that are going to drive the surprises during this earnings season.
When you take a step back, it seems as though an increasing number of people are saying they don't like the valuations. It makes them nervous. The complacency, it makes them nervous. But they're reluctant to sell. Hedging seems to be the more credible way to do this. And it really is the truth, even when it comes to U.S. assets, hedge the dollar. I'm just wondering why that's sort of the mantra this time around, why people are so reluctant to sell, even when they say these valuations are making them a little bit nauseated.
Well, Lisa, for those who sold in April, just after the announcement from Liberation Day, they certainly sold the S&P on its way to 5,000, and they bought it back when the S&P had risen to 6,000. So, there is this now anchor memory in investors' memory that when they sell, they will probably buy the S&P at 5-10 points higher. So investors are very reluctant to sell today, but also I think it's important to focus on the fund manager survey positioning across assets, and it's not on US stocks where you see the big longs. In fact, the exposure to US equities is net underweight. It's on international equities, on international bank stocks, and in particular on European equities and European assets where the big lengths are. And I think the biggest pain trade of the summer would be, yes, a stronger US dollar coupled with lower international equities, lower bank stocks, and a lower euro currency.
Last week, we had JPMorgan's JB Diamond come out and say there's complacency in the markets. Do you think there is too much complacency in the markets when you look at this fund manager survey?
I mean, look, investors are still quite worried about a global trade war. They still view a full-blown trade war causing a global recession as the biggest tail risk. But clearly, they are less worried about this development. Back in April, there was a strong unanimity when it came to the potential downside risk from global trade war. 80% had identified it as the biggest tail risk. This time, it's only 38%. So you see that investors have turned around on the impact and the negative impact of a trade war. They now view the average weighted tariff rate that the US will impose on the rest of the world. They estimate it at 14%. It was 12% last month. So you see that, yes, clearly the risk here is that we see a further escalation on the trade front, because we think that based on sentiment and positioning, risk assets, and in particular the S&P 500, are more likely to react to bad news than good news.
It's always provocative. It is again this morning. Elyas, thank you, sir. Elyas Galou there of Bank of America on their Global Fund Manager Survey. Have you had sticky toffee pudding before?
I have not.
Does that translate?
Not really.
Not at all. Sponge pudding, toffee sauce all over it.
Is it just
like a dessert?
And I understood that. I mean, I understood that
no.
it was, but I wasn't understanding whether it was the stickiness,
never had it,
whether it was the sweetness.
Well, Michael Hahn is English, and obviously he's in London coming up with titles for the research, and when I read it out I wondered whether actually that translated to a Wall Street audience.
So do us all a service, please translate the implication of that.
It's like a soft pudding covered in toffee, but they're calling it sticky toppy pudding, which is the market right now.
Thank you. That's
Get
beautiful.
It? Like replacing toffee with toppy.
One more time. No, I'm kidding. That's very good.
Please, we're on the same page now. Anyway, what jumped off the page for me is what he talked about very close to the end. Most crowded trade right now, short US dollar. Biggest contrarian trade, and maybe even the pain trade of the summer, short euro, long dollar.
And an increasing number of people are sussing that out. And that's one reason why I keep asking how much this market really has priced in the prospect of these tariffs on Europe going into effect at 30% and potentially having a much bigger hit to the European economy than a lot of people are currently pricing in.
Euro dollar 116.71. We'll move on. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump is threatening to impose new tariffs on Russia over its war in Ukraine. In an Oval Office meeting with NATO Secretary General Mark Rutte, Trump said if there isn't a deal to end the fighting in 50 days, he'll impose tariffs of 100%. He also said the U.S. was sending Ukraine top-of-the-line weapons made in the U.S., but according to him, paid for by NATO member states. Meanwhile, Meta CEO Mark Zuckerberg says the company is building a series of massive data centers to supercharge its AI capabilities. The first one, named Prometheus, is expected to go live next year. Zuckerberg says the company is going to invest hundreds of billions of dollars into data center capacity to achieve machine superintelligence. And in sports, Cal Raleigh is the home run derby champion amid an already historic season for the Seattle catcher. Raleigh, who leads the league with 38 home runs, outlasted Tampa Bay's Junior Caminero in the Derby's final round. He's the first catcher in baseball history to win the event. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the programme, inflation data just around the corner.
I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
In just a moment, we'll catch up with Matt Hornbach of Morgan Stanley. Stocks are positive by 1/3 on the S&P 500, up by 0.5 on the Nasdaq. The next stop for earnings, Citigroup reporting numbers in about 12 minutes' time. Under surveillance this morning, inflation data just around the corner.
There's some persistence there. I wouldn't put too much emphasis on one number. I think it's the trend, and I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
Investors are awaiting inflation data for a read on how President Trump's global trade war is impacting the economy. That data is due at 8:30 Eastern Time. Matt Hornbach of Morgan Stanley joined us now for more. Matt, welcome to the program, sir. A question we've been asking all morning. We've had 4 softer than expected inflation reads in a row. Can we make it day 5? Can we make it month 5?
Well, John, we think probably not. When we're looking at the CPI fixings market, it was a very unique marketplace within fixed income that focuses on exactly the index level for CPI. We think it's signaling a chance of a small upside surprise. But I think the issue that our economists have been talking about for some time is that they haven't really expected to see the tariff show up in the data until now. So it's not as if the data that we've gotten so far this year has really surprised our economists. But we think that the tariff effects will show up starting in this report. So I would say if we don't see it in this report to any degree, then you'd have to start thinking somewhat differently. But we'll see in just a little bit.
Can we take that a step further, Matt? You said if we don't see it in this report, you have to start thinking differently. Do you think that this is a decisive moment to understand whether the tariffs are inflationary or not?
Well, any one report needs to be taken in its proper context. There are other things going on in the U.S. economy. It could very well be the case that we do start to see tariff-related effects in goods prices. But what's happening in other parts of the economy, in the service sector in particular, just overwhelm what's happening on the goods side. So we need to look at every aspect of the report to make any broader judgments. It's just one report. We've got a whole second half of the year to get through. So we'll, of course, be paying attention to the upcoming data as it rolls in.
It's interesting to me that when we got the last CPI report on June 11th, yields have barely moved. They're basically in the same place. You've seen a little bit of a move on the front end with yields coming in. Globally, though, it's another picture. You're seeing long end yields across the world, particularly led by Japan, surging higher. Does that give you comfort about investing in the U.S., or do you feel like they're just completely different dynamics at play?
I do think, Lisa, that there are different dynamics at play. Oftentimes, markets march to the beat of their own drummers. Sometimes they march to the beat of one. But I think in this case, we're definitely seeing idiosyncratic developments in different bond markets. I can tell you a detailed story about what's going on in Japan, a separate detailed story about what's happening in the long end of the gilt market in the UK, and then, of course, what's happening in the United States. So every market is different, I think, in this moment. It just so happens that the stars are aligning to put upward pressure on longer-term interest rates.
Matt, you used to trade JGPs about 20 years ago. Can you just share with us your experience 20, 25 years ago and just how much this market has changed over the past few decades?
Yeah, I will tell you, I did not expect my experience 25 years ago to be brought up at this point, but here we are. I do think that the long end of the JGB market is just different in the sense that, the supply picture is largely the same. There's always been a tremendous amount of supply in the Japanese government bond market. But what's different is the demand side of the equation. The life insurance companies in Japan are selling fewer life insurance products to the people of Japan, in part because the people of Japan have other investment options, in particular related to the NISA scheme, which essentially allows the people of Japan to invest for their retirement in a tax-efficient way. That didn't exist 25 years ago. And so there are some different demand dynamics happening in Japan. And of course, because the market is largely a domestic market, those types of structural shifts in demand can have quite an effect on the price, and that's exactly what we're seeing today.
So, Matt, as you know, Japanese investors have a rather large presence in certain European debt markets, in the US Treasury market as well. We've debated on this programme now for a number of months as to whether we would see some form of great repatriation as yields start to back up in Japan, whether we start to see a read-through to other markets as the money starts to come home. Are you anticipating that at all, Matt?
Well, I do think that over the course of time, there will be these kind of glacial shifts in investment direction. I don't think that we're seeing it with any particular impulse in this moment. But ultimately, if yields in the long end of the JGB curve continue to rise, those assets will become much more attractive to investors that sit outside of Japan. And so, of course, the price determines a lot in this business that we're in. If the price cheapens up, you're going to see investment capital chase valuation. And so that could be something that defines the second half of this year.
That experience was useful. Matt Hornbach of Morgan Stanley. Matt, thank you, sir. As always, appreciate it. That market's changed a lot.
Yeah, it used to not be a market. It was suddenly owned by the Japanese authorities, and now it's starting to become a market again, much to the chagrin of those Japanese authorities that now are looking at yields that are much higher. The last question is really important here, the repatriation of some of those assets and what that does to connect the global markets in a way where they don't become as idiosyncratic as maybe they're trading right now.
Do you remember waking up to those headlines every now and again that would just say the Japanese 10-year hasn't traded today? Do you remember that?
I do.
That's the last decade over in Japan in that market.
If you want to talk about inflation being dead, the Japanese bond yield was dead. I mean, really, it was flatlining for a long, long time because it was entirely owned by the government. But all of a sudden, it's not. And it's gotten a lot more interesting. And Matt Hornbach, thank you for that experience.
That's the focus of the global debt markets so far this morning. So far this morning, we've got through a lot. Numbers from JPMorgan, pretty decent. Numbers from Wells Fargo, less decent. In about 5 minutes' time, we'll hear from Citigroup. About 30 minutes after that, we're going to get inflation numbers. And I think it's important to listen to what we heard from the Treasury Secretary, Scott Bessent, a little bit earlier on this morning about the pressure they're putting on the Fed chair. The pressure now on the Fed chair, not to leave immediately, but to vacate the seat once his term expires to allow them to nominate a new governor.
Absolutely, because he thinks it will cause confusion if a Fed chair stays on as a governor, especially with a lot of controversy around this idea of a shadow Fed chair. Much more still to come on our conversation with the Treasury Secretary, Scott Bessent, plus Greg Boutle of BNP, Gerard Cassidy of RBC, Neil Dutta of Renmag, and David Kelly of JPMorgan.
The tariffs could definitely create some inflationary headwinds.
The effects of the tariffs are actually going to take some time.
We will not start seeing the inflation effects until a few more months down the road.
It's still too early for us to start to see a wave of inflation.
The risk to us is that we see a more persistent impact of inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equities doing okay, led by the chip sector and some of the biggest banks in this country. Equity futures on the S&P up by 1/3%, on the Nasdaq 100 up by 0.6. 30 minutes away, CPI in America, inflation data at 8:30 Eastern time, and lots of banks in between. Tomorrow, you'll hear from Bank of America, Goldman, and Morgan Stanley. This morning, just seconds ago, we're hearing from Citigroup.
And they joined the JPMorgan side of things in terms of beats pretty much across the board when you look at whether it's investment banking, fixed sales and trading, net interest income, equity sales and trading across the board beating at a time when a lot of people are wondering about the turnaround plan. Citi's going to be interesting that way. And I am curious about how much those shares are going to respond to this because the bar hasn't been quite as high as, say, those shares of JPMorgan.
Sonali Basak joins us now for a sneak peek of what we've seen in the last few minutes. Sonali, I gave the cheat guide for JPMorgan earlier on this morning. I said beat. And I think I'm seeing the same thing on Citi.
So many beats. And remember, for Citigroup, as Lisa had alluded to, it counts a lot more, doesn't it? You had come into this quarter with Citigroup really trading at a lot less than book value still. Came in at the end of yesterday trading at 85% of book value, just about. When will it hit book value, John? That is Jane Fraser's goal here. Now, remember, they had revamped a lot of their businesses. They have new leadership. So the fact that they're beating on fixed income trading, on equities trading, on investment banking, and net interest income. Remember, the other two banks that reported this morning did not beat on net interest income for this quarter, is very promising for Citigroup, particularly because that bar had been a little bit lower coming in. They're also seeing full year adjusted revenue at about $84 billion. That is above prior estimates. So beat and a raise for you. Once again, pretty rosy out there on Wall Street today.
Shnali Basak with the latest. Shnali, thank you. That's the latest on Citi. So far this morning for the equity bulls, you're getting everything you wanted and more. A beat for some of the nation's biggest banks, a beat and a raise from JPMorgan, a beat from Citi, reversing some of the chip curves, at least that's expected with regards to exporting into China at AMD, at NVIDIA. If we have a clean sweep, it would need to include, at 8:30 Eastern Time, a softer than expected inflation print.
Immaculate disinflation, ongoing strength in corporate America, ongoing suggestion of strength among consumers at the same time that you're not seeing a read-through of those promised tariffs in some sort of increase in prices for consumers. You get the trifecta, we get a new high. That's what a lot of people are expecting.
And the Treasury Secretary was talking about how one print doesn't really matter. It's the trend. So really leaning onto the fact that before today, we had 4 months of straight softer CPI prints. And they're leading into that when they start continuously this jawbone of Jay Powell. Something else that is good news for the markets, he made it very clear the president is not looking to fire the Fed chair.
I imagine, though, that Fed chair is going to face a lot of pressure if we get another soft read at 8:30 Eastern Time. Social media posts are going to begin straight away.
You can almost draft them. If you get a softer CPI print, Trump is going to come out yet again and said, what did he say yesterday? Inflation is, quote, dead, doesn't exist. Well, there's still some inflation. Of course, the issue that this Fed has is the fact that they haven't set the tariff rates. And having this discussion with the Treasury Secretary, he says we're not going to rush deals based off some market deadline. Well, it's not really a market deadline. It's their deadline. They just keep pushing the can down the road.
The S&P this morning firmer by 1/3%. We begin this hour with stocks higher as investors await key inflation data. Greg Boutle of BNP Paribas writing the following. Investors looking to hedge over CPI should consider the Russell 2000. While the vol isn't obviously cheap, the index has been sensitive to CPI surprises. Greg joins us now for more. Greg, good morning.
Good morning.
Let's just get into what you do expect to see at 8:30. Let's start there. What are you and the team looking for?
Yes, our economics team are looking for a print in line with consensus, which is a tick up sequentially to 0.3, both for the core and the headline. I'm not sure that's going to be enough to move the market one way or the other.
Is this a decisive moment in terms of either we see the influence from tariffs or we don't? Kind of the suggestion of this is the month it should show up, and if it doesn't, then you have to rethink things.
I think it's disproportionately important. I mean, one given data point isn't the be-all and end-all, but people are looking for the emergence of that trend to start with this data point. So if we were to see a hot print, I think it would give the market pause for thought.
What would that pause for thought look like? In other words, how complacent has this market gotten to the idea that there hasn't been as big of a real read-through in inflation from the tariffs?
One of the things that we've seen recently in the past couple of weeks has been a large rotation into some of the most shorted names, unloved names, lower quality names. And those are typically names that benefit from a Fed cutting cycle. So I think what we could see is a reversion of that rotation if we were to see a hot print.
So not necessarily a wholesale sell-off, but just sort of shifting around, which seems to be the way people are thinking about things right now.
I think if we got a hot inflation print and that worried the market, you could see two things. One, you could see the market reverse some of the gains, and you could see that rotation under the surface reverse. And in the index space, that would be things like small and mid caps, Russell.
Why would I want to leave what's working so well right now, which is mega cap tech?
Yeah,
and all the right things keep happening, including this morning on NVIDIA and AMD.
Yeah, I'm not sure that you would. I mean, the one message we've had for large cap tech, and you can express this through NASDAQ, is starting to look at delta replacement strategies. This is the idea of owning the upside in the optionality so you can benefit from a trending higher and overshoot if you like, but mitigating some of that risk at all-time highs.
Can we sit on earnings just for a couple of beats? Yep. What are the big tailwinds now for earnings? Because we were talking about the fund manager survey from Bank of America earlier on this morning. Optimism has snapped back around earnings just like that, so quickly, even with all the policy volatility down in Washington, D.C. What are the big tailwinds now?
Yeah, so I think when we think about earnings, they are obviously backward looking and they're going to cover second quarter. The macro data in second quarter remained robust. And then we saw a couple of big incremental headwinds. One is the dollar. Massive dollar depreciation Q2 over Q1. 40% of S&P revenues come from overseas. That's just a big mechanical translation effect. The fiscal measures we've seen, one big beautiful bill, that's something we don't think is reflected in the sell-side consensus yet. So there are two kind of mechanical tailwinds, if you like, that should drive some upgrades post-earnings.
At the same time, there's the huge headwind, which is the tariffs, that we don't really have a sense of exactly what the rates are. Is this a market that doesn't think the president is actually going to go through with the rates as he's proposed even over the weekend? Or is this a market that says, even at that pace, it's fine? And companies have shown their ability, as Tom Keene would say, to adapt and adjust.
I think it's a market that doesn't know. So what people are trying to do is to trade the data points as they see them. So we've become a little bit more numb to the headline risk, and instead people are going to try and trade the data. That's why CPI today is super important and earnings season.
The Treasury Secretary was talking about how the narrative of obsessive focus on the market is not right. And then he says, I'll tell market participants not to worry on August 12th. That's when the détente, that deadline is up between Beijing and Washington. So if they're telling you not to worry about these deadlines, do you just take everything that's coming out of the White House right now as pure negotiating tactics?
You can see that the market isn't really worried about the deadlines, because you can look in the options market and see where risk premium is priced. Risk premium is priced for things like today with the CPI print. It's priced for the FOMC. The deadlines coming out the White House do not see kinks in the volatility surface that suggest people are trying to hedge those specific dates.
Is that because people believe it doesn't matter, or because it won't happen? Because there are two very different interpretations of all of this. Lisa talked about the adapt and adjust that TK would always talk about with companies. Certainly there is some evidence of corporate resilience. Is it that it doesn't matter, or is it won't happen?
I think it's more that people are uncertain as to whether it happened or what extent it will happen and where will you see that impact. And I think that at the moment people have tried to trade the headlines. It hasn't really worked, so people are taking to trade the data instead.
I've struggled with the data. Never mind trading the headlines. I'm struggling to trade the data. When we get these numbers in 22 minutes' time, if it's softer than expected, and I've got no idea what the number will be, some people will say that's signal. Companies are handling it well. Maybe they have to take it on margin. They can't pass it along. Whatever. Other people will say it's noise. All this is pre-tariff inventory. We're still working through it. Wait. Just wait, and you'll see it eventually later on this summer. That was the argument the month before. We're going to hear that potentially again at 8:30 Eastern time. How much can you read into the economic data that we're getting?
I think sequentially as we move forward, you start to read more into it. I don't think anyone expected the backward-looking data at this point to show anything, but I think people do expect there to be, the early signs of impact in this print and into the next print. So this print, the next print, I think if they were very soft, it would be hard to look through that.
This market's been trained, conditioned by experience. When in doubt, just buy. When in doubt, just look through everything. It's just going to be noise. Does that create a certain fragility? The lack of a response function in markets to headlines that could potentially be transformative and potentially facing a rude wake-up call?
Yeah, I think it really increases the risk that we overshoot. People become numb to the headlines around tariffs. And then if you were to see an actual economic impact, if that comes later over the next couple of months and people have managed to rebuild those equity longs, then it can be more impactful.
Greg Boutle of BNP Paribas. Greg, appreciate your time. Next stop for this market, 8:30 Eastern time. I have no doubt, whatever the number will be, the debate will continue.
Right now you have ranges in terms of estimates on Wall Street from 0.1% to 0.4%. That's a pretty big delta. So you're looking at people who have their finger in the wind trying to figure it out, and it seems like everyone has a different answer.
Might not sound like a lot. Might not sound like a lot.
It is.
But you can drive a truck through that. That's a big spread on Wall Street.
Especially because it's not just headline. This is actually, even in core, when you strip out energy and food, it's the same range. People don't understand the response function from corporations that have set contracts with their suppliers and are trying to figure out what they're going to do with all this.
The difference between 0.1 and 0.4 is a very different conversation at the end of the month on the FOMC. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us. Here's Yahira. Hey, Yahira.
Hi, John. We start with Citi results. Traders there posted their best second quarter in 5 years. Revenue from the bank's fixed income trading business soared 20% to $4.3 billion, beating the $3.9 billion predicted by analysts in a Bloomberg survey, while Citi's stock traders hauled in $1.6 billion, boosted by volatility amid President Trump's trade war. Meanwhile, the Port of LA saw its busiest June ever after a slump in May, with the whipsawing trade war pushing shippers to beat shifting deadlines. But trade forecasters expect a severe drop for the rest of the summer and through the holidays starting in November, which is typically peak season at the ports. And Andrew Cuomo's bid for New York City mayor is not over. The former governor announced he intends to run in the general election in November. Cuomo's announcement follows his decisive loss to upstart Zohran Mamdani in the Democratic primary. Cuomo will pledge to drop out if he isn't Mamdani's highest polling opponent by September. That's according to a person familiar. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, the morning calls, plus Gerard Cassidy of RBC Capital Markets with bank earnings underway from New York City. This is Bloomberg.
Be a judgment that the Chinese indigenous manufacturers already have an equivalent chip. So if there's an equivalent chip, then the NVIDIA H20 could be sold. One thing that we do not want is a digital Belt and Road springing up around the world because other countries or China are substituting for our American chip manufacturers.
It's a change in Washington, D.C. That was the Treasury Secretary, Scott Bessent, on these chip manufacturers. NVIDIA up in the pre-market by 4.5%. AMD up by close to 5%.
This is the same administration that in April said you cannot export this chip. The concerns were about national security. Now they were saying this was a chip in the negotiations. It was part of the, quote, mosaic of the trade talks in Geneva and London with China. And then when it comes to that August 12th deadline, the Treasury secretaries, I tell market participants not to worry.
All I can say is Jensen Huang has a front seat. And this is the view he's been putting out there, digital Belt and Road. And if you want to compete in terms of international use of U.S. technology, you cannot have these bans, et cetera. That's gaining clout in the White House. That's what that meant to me, given the fact that Treasury Secretary Bessent really referred to that kind of idea.
I think it's more than just having a front seat. I think he's almost driving the car. This is an individual that went and met President Trump. Now you see this reversal. He announces it himself on his blog and in China to his Chinese customers. This was the person that also really was pushing this administration to get rid of the diffusion rule, putting the world into AI buckets on where and how they could export some of these chips. And the Trump administration did that. And he is getting a mass amount of money flowing in from the Middle East, and now he's going to get back on China's market.
There's some big moves in the pre-market. Those two names driving gains this morning. Equity futures on the S&P higher by 0.3%. On the Nasdaq up by 0.5%. That's the price action. Here are your morning calls. First up, Morgan Stanley downgrading Freeport-McMoRan to equal weight, coming ahead of a 50% tariff on U.S. copper imports. Elsewhere, your second call from JPMorgan downgrading SolarEdge to neutral, pulling back after the stock's outperformance since May. That stock is down by 1.65%. And finally, Jefferies downgrading DoorDash to hold, saying there is not enough to justify continued outperformance. That name is down about 1% in early trading. Let's turn back to the big banks. JPMorgan and Citi beating expectations. Wells Fargo cutting guidance and missing net interest income estimates. Joining us now is Bloomberg's Sonali Basak. Sonali, a few different stories there already this morning.
Definitely. You have JPMorgan, as you say, beating expectations as well as raising guidance, which is a welcome news for Wall Street. However, John, one question I still have, and we have to wait till the calls to hear exactly what executives say about this. Credit quality has held up remarkably well. Loan growth has expanded in the credit card businesses in particular. But if you look at it in the current quarter, even if JPMorgan raised their expectations for the year, for JPMorgan and Wells Fargo, net interest income came in below expectations. Is there a bit of caution? Even if you're having good numbers flow through the banks, is there caution when it comes to meeting the consumer? JPMorgan CEO Jamie Dimon and CFO Jeremy Barnum are now talking to media, talking about that caution and how easy it is to get complacent at this level. I want to point out they also nodded to what Annmarie was talking about a little earlier. Certainty when it comes to the big, beautiful bill. It gives confidence to corporate clients to move forward. And you do see them starting to capitalize on those Wall Street businesses, which bodes very, very well for Morgan Stanley, Goldman Sachs tomorrow. What I'll be watching watching for today is, are you going to be in a situation where Morgan Stanley's price to book ratio here actually jumps past that of JPMorgan because they're so much more weighted in those Wall Street businesses? That could be a good barometer for you in terms of how Wall Street feels about these businesses.
Look for that in the next 24 hours. Shanali, thanks for the recap. Appreciate it. Shanali Bessent helping to lead some of the coverage of bank earnings this quarter. We have had a stunning rally over the past few months, a rally of more than 38% off the lows of April for the KBW Bank Index. To discuss, RBC's Gerard Cassidy joins us for more. Gerard, a rally of almost 40% on the bank index. Do you see enough this morning for this rally to continue?
John, I think it certainly supports higher valuations. Now, certainly we're not expecting that kind of move over the short term, as we just experienced, as you pointed out. Understanding, of course, the bank sold off very hard from the February highs into that early April time period. But it's not only the results that are driving these stocks higher. As you and I have chatted in the past, it's really about the deregulation opportunities for the banks. And that's a big support for the bank valuations at these prices.
Gerard, how do we understand what's been priced in? That's been the big concern with the likes of JPMorgan, and that's the reason why you're not seeing a response even after beat, as John summed up. How much can we understand the deregulatory impulse as well as a pretty steady economy and rates relatively high? How much have we really factored that already in the price?
That is the $64,000 question, Lisa, because it's very hard for investors to really determine with a high degree of calibration of how much is priced in. Certainly something is priced in, as we all know. The question is it all priced in? And I think what we'll have to wait and see is, as we enter into the fall and we see what these new guidelines will be for the Basel III endgame, that will determine how much really is priced in. We expect the results or the proposal when it comes out to be quite favorable for the banks. So certainly a portion of this good news is clearly priced in. The question, as you point out, is it all priced in? We don't think so, but a good portion of it is.
Right now, the call for JPMorgan is ongoing, and Jamie Dimon has come out. A couple of headlines here. I'm not listening to the call, obviously. We're here. But some of the headlines include this. Independence of the Fed is absolutely critical. Putting aside this question about the independence of the Federal Reserve, what would happen if the Fed dramatically dropped interest rates? What would happen to the outlook for banks, given that they've really benefited in terms of where rates are currently?
It's interesting because you certainly don't want the Fed funds rate falling back down to the levels of where it was right after the pandemic of 0 to 25 basis points. And I'm not suggesting even in our first rate cut we'd ever see that. But if we can have a gradual decline in the Fed funds rate of, let's call it 75 to 100 basis points over the next 12 months, that is still very favorable to the banks. It's really kind of off the cliff drops that would be disruptive, meaning if we got a 100 basis point rate cut, which again, nobody's expecting, but that would certainly be disruptive. But a gradual decline of 75 to 100 basis points at the front end of the curve and the long end of the curve stays anchored around 4.5%, we would view that very favorably for the banks.
Gerard, I'd love to get your take on the tariff volatility. It's clearly been an opportunity for these banks when it comes to trading, but at the same time, they do talk about this uncertainty that still lingers overall in the economy because of that uncertainty. Do you think that the volatility that's emanating from Washington, D.C. has been helpful to these banks, or more so that they would rather clear-cut clarity as soon as possible?
It's a mixed blessing, actually. When you look at the money center and the investment banks, the trading revenues for these companies are much greater in size than the investment banking revenues. Trading revenues benefit from increased volatility. Investment banking revenues, not so much. So from that standpoint, you would certainly say from a pure investment banking trading standpoint, they've benefited. On the other hand, however, when it comes to corporate lending and borrowing, the uncertainty is weighed, I think, on the loan growth prospects for the industry. So that would have to be on the negative side of the ledger when it comes to all of this tariff talk and the uncertainty associated with it.
Gerard, final couple of questions. Next time you're here in Manhattan, when you walk down Park Avenue and look up, you can't miss it. The tower is basically completed now. And a lot of people thought once the tower was completed, maybe we'd hear something about Jamie Dimon's future. And I wonder, Gerard, from your standpoint, how close we are to seeing that headline drop across a Bloomberg terminal that said Mr. Diamond has decided to call it a day. How close are we?
John, I think if I was asked that before their investor day, I would have said it maybe sooner than we all realize. But Jamie Dimon made it very clear at his investor day. He's, having a time of his life. He's having a lot of fun, and he's delivering great numbers. And he has no real plans of retiring anytime soon. So I think we're going to have to wait longer than when that tower is completed for him to announce his retirement.
5 more years?
No, not 5. I would put it less than 5. I would, if you had to be a betting person, probably he'll retire in the next 2 to 3 years. But that's just a guess on my part. I have no insight on his retirement plans.
Gerard Cassidy of RBC Capital Markets. Gerard, appreciate your time, sir. As always, thanks for this morning. Working through numbers from JPMorgan, from Wells Fargo, from Citi too. The future of Jamie Dimon. Apparently it's not 5 more years, but it's certainly not just 1.
I have a theory, which potentially, if you have President Trump in the White House and President Trump clearly respects Jamie Dimon, and Jamie Dimon can say certain things, and he clearly had an impact on President Trump, then if he stays in at the helm of JPMorgan for the remainder of President Trump's helm, then when President Trump leaves, then, we could start talking about politics again.
Bessent to the Fed and Diamond to the Treasury.
I don't know. I'm just thinking out loud. So
Democrats are idiots. That was a line you used recently. I don't know if that was an audition for a seat that might be opening.
You can collect them. Collect the quotes, I'm just throwing out there, this would make sense for him to be in that role and then to, look
also,
for a better.
The tower's not open yet. The man clearly wants to hold court, at least for a year minimum.
Cut some ribbon.
In his tower.
Do all of that, take some photos.
Have you ever been to a ribbon cutting?
No, I haven't.
It's really, I've always, the sort of pomp and circumstance, the size of the scissors, the size of the ribbon.
The idea of smashing the champagne against a boat. It's more my scene than a ribbon cutting.
Is that so? Yeah, you seem like a real champagne
isn't that more your
across the
scene,
boat?
sort of smash champagne against boats?
Definitely. Ribbon cuttings are underwhelming.
Yeah, I'm not into that.
I don't like the broken glass, and if you go down on the bottom, you cut your feet. All right, let's move on.
Serious stories up next. We've got US CPI. You wouldn't know based on this conversation. Neil Dutta of Renmac joins us in just a moment. David Kelly of JPMorgan Asset Management here to react. We've had a string of softer than expected inflation reads in the United States of America. We've had 4 months of it. Will this be month 5? The data drops in about 5 minutes' time. Going into it, your scores look like this. Equity futures on the S&P 500 firmer by 0.2%. Bond yields are higher at the front end by 3 basis points going into this, 3.93. The opening bell is 60 minutes away. We're seconds away from inflation data, which may dictate how we open later on this morning. Equity futures positive by 0.25% on the S&P 500. On the Nasdaq 100 up by 0.5. Turn to the bond market. The scores in fixed income look like this. 2-year, 10-year, 30-year. Yields at the front end of the curve higher by 2 basis points. The 2-year, 3.92. With your economic data this morning, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. We've got an upside surprise here that kind of makes a little hash of perhaps the Treasury Secretary's claim that inflation hasn't hit yet. CPI comes in up 0.3%. The downside surprise, though, is in the core, up just 0.2%. Both were up a 0.1% last month. Year over year, we go to 2.7%, which is higher than the anticipated 2.6%. It's a 0.3% move up from last month, and the core is at 2.9%. That is what was expected. Last month, it was 2.8%. Let me just quickly mention Empire Manufacturing goes up 22 points to a positive 5.5. Important because that's July number, one of the first July numbers we get, and it is the first time it's been positive since February. Prices paid, though, went up. I'm going to check whether we have a tariff impact here while you check the markets, John.
Mike McKee, thank you, sir. I'll come back to you in just a moment. Your headline on the first read, the 5th consecutive month of softer than expected core CPI in America. 5 consecutive months, all the talk of higher prices, just not coming through. Not yet, you might say, but it's not here this morning, not at the headline, and not in core. Core CPI, 0.2%. The expectation in our survey, the estimate, 0.3%. 0.3. The previous month, 0.1. In the equity market, we like it. We're up by 0.5% on the S&P 500. And in the bond market, fixed income likes it too. Check out Treasuries. Yields lower at the front end and the long end. On a 10-year, we're down by 3 basis points. Bramo, 439.
If people were expecting to see some sort of runaway inflation on the heels of tariffs, they didn't see it in this report, particularly, as you said, with core ex-food and energy coming in softer than expected, 0.2% versus the expectation for 0.3%. You could see the yields coming in on the heels of that. Now the question is, how much does this really change people's outlook going forward of whether we will see those implications or whether this actually does give you a sense of how people are adapting and adjusting?
We'll come back to Mike McKee in just a moment. I want to bring in Neil Dutta of Renaissance Macro. Neil, welcome to the programme, sir. That's not 4, it's 5. Why is that signal and not noise?
Well, I mean, I think, look, we're obviously tariff revenues are going up, right? And the effective tariff rate is rising. That was the case in June. And despite that, inflation missed expectations. So that means that, I mean, tariffs increase costs. We all know that. Who ends up bearing the cost is where the debate is. And, you know, I think at the margin, this probably reflects more of a margin squeeze than anything else. It's not like prices for core goods aren't going up. They are. But you have, you know, I mean, I was just looking at the data. You see big increases in appliances. You see big increases in all sorts of household furnishing and supplies. But it's also important to remember that service sector inflation, service sector prices represents the lion's share of what people spend their money on. And prices in those areas continue to go down. You know, ultimately, it's going to come down to nominal dollars spent. Right. So to the extent that people shift more of their household budgets towards goods because the prices of those things are going up, they'll have less left over to spend elsewhere. And that means that services are at risk. And that's why they'll ultimately see the prices for those things coming down. So that to me seems to be what's going on. The nominal anchor isn't changing. Tariffs are resulting in a relative price shift. That's pushing up the prices for consumer goods. That is clear. If you look at the data, that's obvious. Look at household furnishings in the latest report. But services are providing an important offset.
Neil, is that a good enough reason for 2 Fed governors on the FOMC later on this month to stick their hand up and say, I think we should cut rates?
I mean, I don't think they'll be as noisy about it in July, only because, you know, the last employment report gave them some calm, right, because the unemployment rate went down. But, you know, ultimately, you know, for me, it's about, you know, what is nominal income doing? When you take like the sum product of jobs, hours, and earnings, and you look at it over the last several months, it doesn't look particularly encouraging. At the same time, you've seen the work week decline, particularly in the areas that are seeing the most robust jobs growth, like education and health, right? So if you start to see jobs in those areas slow down, what's left? You know, I still continue to have like concerns about the job market over the summer. But that just reinforces this weakness in nominal income that we've seen. So ultimately, you know, it all comes down to like the household budget constraint. And to the extent that prices are rising in one area, that means that quantity is going to go down in other areas.
So, Neil, just to sort of sum up what you've been talking about, I think it's really interesting that you see these numbers as not representing strength in the economy, but a sign of weakness in places like services that is bringing down the overall inflation rate that otherwise is getting inflated by certain goods prices going up, like home appliances. At what point is that weakness necessary to keep inflation low? In other words, not necessarily a reason for the Fed to cut, but to hold where they are so that you can have that offset in a way that doesn't allow inflation to really kick back up.
I mean, I don't think one rate cut's really going to change that in any material way. I mean, the Fed policy is still restrictive. That means they can start and they'd still be restrictive. They don't have to promise like a broad swath of rate cuts. In fact, they're not doing that. So, you know, I don't think a rate cut in July or even one in September is going to materially, you know, change that dynamic.
If you are just joining us, welcome to the programme. Equities higher here, the opening bell about 54 minutes away. Moments ago, inflation data in the United States, month over month, headline CPI up from 0.1% the previous month to 0.3%, in line with expectations. But for core CPI, it's another downside surprise, 0.2% against an expectation of 0.3%. It's 5 consecutive months of softer than expected core CPI. Mike McKee's back with us for more. Mike, you've had a second look. What jumps out to you?
Well, I think Neil pointed out the major tariff implications here. We do see a 0.4% rise in apparel overall and a significant rise in footwear, up 0.7%, male footwear in particular. Now, those things come from China. Other things coming from China that go up or from other Asian countries. Furniture, as he mentioned, was up 0.4%. Household furnishings up 1%. And appliances up 1.9%. They were up 0.8% last month. A lot of this probably has to do with the tariffs on steel. We saw that when we had the steel tariffs in the first Trump administration, that appliance prices went up. Food, 0.3%, still in line. President added extra tariffs on tomatoes yesterday, but in June they were down 1.5%. And I know Annmarie is anxious to know that eggs were down 7.4%. One other thing that comes in for the China aspect of it is toy prices up 1.8%. So we are seeing some tariff pass-through here. But again, I would look at what Neil was saying about service prices. They were relatively restrained, up 0.3%. We saw medical care and auto insurance prices very tame this month. So some of the things that we had seen pushing up inflation in the services categories have backed off for a while at least.
Mike McKee, thank you, sir. Equities higher in response to some of this. We're up by 0.4% on the S&P. Yields a little bit lower across the bond market. The yield curve looks like this. 10-year yields this morning down by 2 basis points. Similar move on a 30. So you don't see the tariff inflation on a headline, but you start to see it just a little bit beneath the surface.
And you start to see what the response function is of households, that they might be cutting back maybe on eating out to compensate for the increased costs elsewhere, which you wonder on a compositional level whether this tamps down overall inflation, even as you see pockets of higher prices in select areas. Is that the path of travel? Or is that just the current state of affairs as people take stock of exactly what the new scenario is?
We can have that discussion right now with David Kelly of JPMorgan Asset Management. David, welcome to the programme, sir. How much comfort can you take from this morning's inflation data?
Not a lot. And it's a very interesting report because you can see sort of the fading of issues that were causing inflation over the last few years. But you can also see the beginnings of the inflation problem related to tariffs. So if you look at owner's equivalent rent, auto insurance, those are the things that really held inflation up, and they're going away. And the other thing that really helped this report is we had a further decline in airline fares, a further decline in lodging prices. There's a lot of weakness in the tourism industry right now, and that's in this report. But when you look at core goods outside of new autos, we're seeing those goods prices go up, and that's where you're going to see this tariff inflation. And we have only seen the thin end of the wedge here. It takes a while for the tariffs to be implemented. It takes a while for the revenue to be collected. It takes a while for the inventory to make it to people's shelves. It takes a while for the retailers to say, look, I'm going to have to mark it up. But it is coming. So, I fully agree with the Fed's forecast that inflation is going to go up between now and the end of the year, and they've got to stay on their guard.
And yet, David, they also believe it starts to come back down again. In fact, for that reason, some officials, including Governor Waller, believes you can look through it. Do you think you can just look through it?
Not yet, because we also have a lot of fiscal sugar in the first half of next year. What's going to happen is that we had a lot of temporary tax breaks put in for 4 years, but they start at the start of this year. They're not going to adjust income tax withholding schedules quickly enough. That means a bumper season for refunds early next year. And, we know from 2022 that you've got supply chain issues, and then you give consumers a lot of extra cash. What happens? You end up with inflation. Eventually, I think it'll fade. In the long run, I am not an inflation hawk in America. I think inflation will fade, but I think it's going to be sustained by some of the provisions of the OBBBA. Because of that, I think the Fed needs to hold off here. If we got clarity on tariffs, if we could say this is what the tariffs rates are and they will go no higher, then I think that makes it easier for the Fed. So, I think the administration really needs to think about, look, could we please, whatever the tariff policy is, let's make it and be done with it. Because this uncertainty is the very thing that's making it impossible for the Federal Reserve to say that we're out of the woods or will be out of the woods on inflation.
David, is there a sort of a necessary weakness that we need to see in consumer spending and services at this point to make sure that inflation doesn't take off? In other words, that pain that Neil was talking about that you could start seeing in the data on the margins.
Well, that's a tough way to do it. I mean, the way you want to, if you're worried about a long-term inflation problem, it's only going to come because wage growth sort of compensate for price increases. Now, we still have a relatively weak labor force in terms of their ability to demand wage increases. I think, again, we have to think a little bit about how immigration is affecting labor supply. And again, there's huge question marks there. But so long as we don't see an acceleration in wage growth, the inflation will fade. It's not just a matter of consumer spending being weak. So long as wage growth is controlled, inflation will fade again. But I think it's way too early to say that inflation's coming down to 2%. We've still got to get past tariffs. We've got to get past the stimulative effects of this fiscal bill. And that's really what's causing the delay in any further Fed easing.
Neil Dutta of Renmax still with us. Neil, today's about prices. Thursday's about spending. Let's talk about retail sales. How do you expect some of our understanding of prices this morning to show up in spending and retail sales later this week?
Well, I mean, if goods prices are rising and the consensus expects nominal retail sales to rise 0.3, that basically tells you that real spending on goods is declining. That's not exactly an encouraging situation. So, the fact that price increases are showing up, and it's more or less matching what you see in the retail sales data, that basically tells you that the volume of goods sold is going down. Look, it comes back to P times Q. Whatever goes into price is going to come out of quantity because the nominal anchor hasn't really changed. I think consumers are actually quite resistant to higher prices, with the exception of the University of Michigan data. If you look at other estimates for inflation expectations, whether that's the New York Fed survey of consumer expectations, Atlanta Fed business inflation expectations, professional forecasters inflation expectations, it suggests that people are resistant to higher prices, and they're acting as if you look at the areas where people have been cutting back their consumption, those are the areas where the prices have been going up the most. So it's not particularly surprising. And the labor markets remain still in a tricky spot. While the unemployment rate remains low, you still have rising increase in discouraged workers. People that are out of the workforce but want a job now. Companies are telling you, like the small businesses are saying, that there's poor sales are a bigger concern. So I think that probably reinforces ongoing weakness in wage growth, and that means that households don't really have the capacity to absorb higher prices, and
David,
that means that they have to cut back.
No, and it's a good point, Neil. And David, I guess that if you take what Neil is saying, the idea that you do see real price resistance by consumers, and if you do see this sort of compensating for the extra expense in goods by pulling back on services, what would the harm be for the Fed to cut rates by just 25 basis points or 50 basis points?
Well, any problems the economy is facing is not really about interest rates being too high. And I think we have to think carefully about long-term policies, about helping the labor force grow, about helping free enterprise and reduce regulation and reduce barriers to business. And I think we need to focus on that. I don't think the interest rates are too high right now. I think the Fed's the steward of the dollar and of our inflation outlook in the long run. And they've said they're committed to 2% inflation. I think they should stick to their guns. If the economy gets into trouble, it's not because they kept rates too high.
Neil, I just want to give you the final word just on housing, which is something you've been following now for months and months and months and flagging the weakness here. Why is that so important to you, Neil?
Well, because it undercuts the argument that was just made, which is that, that interest rates are fine, right? I mean, obviously, housing isn't weakening because of tariffs or anything else. Housing's weakening because rates are too high, and you're seeing, a rising pile of completed new unsold inventory. I mean, that hasn't been as high. That's been rising, over the last year or so, and that's starting to weigh on home prices, which we see. So, I think that the housing market does provide some evidence that interest rates are restraining economic activity.
Is that the Fed's fault, or is that the fault of Congress, Neil?
No, but the reason we're seeing that, the reason The reason we've got trouble in the housing market is not because rates are too high now. It's because rates were way too low for way too long after the great financial crisis, causing prices to jack up to a level that cannot be supported at normal mortgage rates. There's nothing wrong with mortgage rates. The problem is home prices, which are too high because rates were too low for too long.
Well, mortgage rates are running 6.5% to 7%, and wage growth is rising just 3%. So I think the math is actually getting quite challenging for most people. That's why housing's not working.
Well, it's challenging, but only because home prices are the anomaly here. They're just too high because rates were too low for too long.
I'm sitting back now, gents. I thought you'd continue. Neil Dutta of Renmac, David Kelly at JPMorgan. To the two of you, appreciate it. Thank you. A robust debate there at the end. Just on mortgage rates, this is the issue. Is it the Fed's problem or the fact that we just passed one big, beautiful bill, which a lot of people think will keep yields elevated, particularly at the long end?
Yeah, or is it the fault of, with respect to the housing market, is it the fault of not building enough and some of the generational wealth? Look, you can take two different people and obviously have three different approaches to the same issue, which is the reason why it's unclear exactly what the remedy to some of these issues is.
But what happened when the Fed cut last year? Didn't really affect mortgage rates. Mortgage rates are still climbing. Mortgage rates are still challenging. But to Neil's point, this is a huge problem. How do you get on the property ladder when you have a mortgage rate of 6%? In this report, though, housing costs, biggest factor, 0.2% rise in June, essentially a tame reading, according to our T-Live blog, compared to elevated figures we've seen in the past several years. So maybe the actual housing costs are coming down. But the issue, of course, mortgages.
So guess what? We had the data 20 minutes ago and we've settled absolutely nothing. It is the fifth consecutive read of softer than expected core CPI. The details just encouraging some of the thinking around tariffs starting to come into higher prices. You just don't see it at the headline level right now. And Neil Dutta broke down as to why.
This is the reason why people just buy NVIDIA, because ultimately, if you can't parse through this and you can't decide on anything, well, you can decide on one kind of secular story, and that's what people are doing.
Futures this morning positive by a third of 1%. The gains continue.
Because
NVIDIA, AMD. Let's get you an update on a story elsewhere this morning. With your Bloomberg brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. Recapping the latest economic data, underlying U.S. inflation in June rose by less than expected for a fifth straight month, as you mentioned. Core CPI rose 0.2% from May, lower than estimates calling for a 0.3% increase. The print was dragged down by car prices. Meanwhile, Fed Chair Jay Powell has asked the central bank's inspector general to review the $2.5 billion renovation of its Washington headquarters. Some Republicans and Trump appointees have criticized Powell for cost overruns around the project. It's a new line of attack as the president continues to criticize Powell for not cutting interest rates further. And this morning's CPI print could bolster his case. Meanwhile, Starbucks will require its corporate employees to work 4 days a week in office starting in late September. The coffee giant currently requires employees in person 3 days a week. CEO Brian Niccol, who initially wasn't required to relocate when he was hired last year, now has a residence and office in Seattle, according to the company. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Every time I've seen these stories, I say the same thing. They're still doing that.
I know.
They're still doing that.
Yes, and they have been gone with this kind of protocol before. It didn't work.
Well, the CEO, I guess, had to move, right, to really bring down the hammer.
And apparently he's got an office now and he's ready to go. OK, good news. Up next on the programme, setting you up for the day ahead, plus Danny Berger with your morning movers on the latest on the big banks. JPMorgan down in the pre-market by 0.5%.
President Trump said numerous times he's not going to fire Jay Powell. There's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. It'd be very confusing for the market for a former Fed chair to stay on also. I think I have the best job in town. I will do what President Trump wants.
The Treasury Secretary, Scott Bessent, earlier on Bloomberg Surveillance. I think we made some progress this morning, some additional clarity on the race to replace Fed Chair Jay Powell.
He said the process is underway. He said he is part of that process, but putting a little bit more distance between part of that process as a potential candidate or individual that is interviewing these candidates and guiding the president. He also talked about the fact that it was very clear to me that this administration definitely does not want Jay Powell to stay on as a governorship. And I think it was pretty clear indication that potentially that's not going to be happening.
He said his or her. You pointed that out in terms of who the next Fed chair could be. All right, Mickey Bowman, is it now going to be,
hey, who knows?
Kevin, Scott, Chris
and Mickey.
And Mickey, thank you. You're much better at that than I am.
Never mind.
Okay,
it's not
let's
a skill
keep going.
worth acquiring, all right?
Come on, let's keep
Don't
going.
need to develop that. 36 minutes away from
Ferro.
the opening bell. Equity futures don't do that. Positive, no one wants that. We're up by 0.4% on the S&P. I love this job. On the Nasdaq 100, we're up by 0.7. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. A recap of the banks, a beat and a raise from both JPMorgan and Citi. For both of them, really strong trading results. For JPMorgan, a surprise gain when it comes to their investment banking. Still, shares are a little softer for that. They gained for Citi, for Wells falling after a miss. Meanwhile, it looks like both AMD and NVIDIA will once again be able to sell more AI chips into China. A big hit they had taken on those U.S. restrictions was seemed to reverse, so both those gaining more than 5%. Finally, ending it with CoreWeave announcing a $6 billion project in Lancaster, Pennsylvania to build a new AI data center. John.
Danny, thank you. Some of the names to watch going into the opening bell. Some of the things to look for through the rest of this week. Today, President Trump participating in an energy and innovation event in Pennsylvania. Look out for some comments there. Looking ahead to tomorrow, more bank earnings from Bank of America, Goldman Sachs and Morgan Stanley. Plus, PPI, Thursday, retail sales, another round of jobless claims, and then finally, a useless piece of information, according to some of you, not me, according to some of you, the NewEdge Consumer Sentiment Survey before the weekend.
To me, the big takeaway from today is strength. That's what we're seeing from the banks. We're seeing consumer credit hold in, and that's what we're seeing in terms of inflation not coming in particularly hot.
Not coming in particularly hot on the headline. That's something this administration, I'm sure the president is waiting his 4 minutes to send out the Truth Social. This is another yet good inflation report. But under the surface, you're seeing a little bit of tariff impact.
Some resilience in the United States of America. Coming up tomorrow, our lineup looks like this. George Goncalves of MUFG, Cara Murphy of Kestra, Phil Camporelli of JPMorgan, and Senator Bill Hagerty of Tennessee. From New York, this is Bloomberg.